alternative risk transfer. So what is this ART, alternative risk transfer? We will be very much well versed about what is reinsurance and how this mechanism works. So it is very much similar to how a policyholder takes a policy with an insurance company. In a similar manner, the insurance company goes to a reinsurer and he takes a protection in form of a reinsurance policy. So this is the traditional method of reinsurance mechanism. Whereas these alternative risk transfers, they are multidimensional. There are endless possibilities and probabilities to take different types of covers which were unthinkable in reinsurance. So I'll just shed some light on certain ART methods which will be having importance in the point of your exam preparation. So I'll begin with self-insurance. So self-insurance can be very simply put as a retained level of deductible. I'll begin with an example. Let's consider a big company which is having capital in terms of lakhs of crores. So this big company can afford to cover certain risks of at least a certain level. For such a huge company, a risk or a loss of about 1 crore will be very much manageable by itself without reinsurance or without insurance support for that matter. So what this company can do is they can just, for every year out of the profit earned, they can just mark up a certain amount and they can put it inside a fund. And at the time of a bad year, this fund can be utilized for mitigating the losses. So this is very simple concept of self-insurance. But this self-insurance concept is not accredited by many regulatory bodies. I'll tell you why. Because this is solely at the hand of the company. So the company who is constituting or who is contributing for this fund, they can prudently keep this fund for bad years, or they can, for the sake of getting better investment profit, or for the sake of doing certain other investments, they have no hold. They can just invest this fund in some other place, and at the time of really bad need, this fund might not be available for them. So this entire thing is completely managed by the company. Hence, the regulatory bodies, they won't accept these kind of risk transfers, self-insurance. And I'll next pass on to risk retention group, RRG. This self-insurance and RRG, these both are largely US-based concepts. So both of these concepts are very much alien to other part of the world, because the insurance regulations, as we are very much aware, in US and Canada, they are very much opposite to what other part of the world practices. So risk retention group, this RRG, risk retention group, is constituted in US. This constituent will be done by a few of the insurance companies who are originated and operated in US. So what they'll do is they band together and they form a child company. This child company will be registered in certain states of US, and it will be working as a standalone company, receiving the support from the parent companies. This child company will solely operate to give claims for liability covers. We all know US is a market where huge liability claims are very much favored by the courts. So these companies, these child companies, they are operated and they are constituted solely to settle liability claims. So how this will work? The parent companies, what they'll do is whatever the liability premium they collect, they put it as a capital for this child company. So this child company, it will have a fund which it will collect all these premiums from the parent company, and it will invest this fund and it will be keeping it for any claim in terms of liability. So since 3 or 4 companies band together, it is not possible that at the same time all these companies will be getting liability claims of huge quantity. So the risk is shared. Hence, this child company can be easily used to manage the liability claims. That is RRG, risk retention group. So I just wanted to inform the self-insurance and RRG, and I just wanted to make you understand. Both of these are not accepted in the world market because these are very much US-based concepts. So you just have an idea what the self-insurance is and what RRG is. Self-insurance is solely done by the company by itself. RRG, whereas is completely different. It is a group formed by multiple companies to solely meet out liability claims in US. Now we'll move to pool. Pool is very much familiar concept to all of us, because in India also we have terrorism pool and nuclear pool. Earlier we used to have motor TP pool, which have been disabled now. So in pool, what happens is it is kind of similar to RRG, but the operation is somewhat different. So how this pool will operate? I'll explain. For a pool to be constituted, there will be some 3 to 5 companies. Let's say in India, 4 public sector companies. They wish to create a pool for terrorism risks. They first have to approach and find a pool manager. Every pool will have a pool manager. In India, it will be mostly GIC-RE. So GIC-RE will be the manager of any pools that is constituted in India. So the public sector companies, they'll approach GIC-RE and they'll convey their interest to form a pool to support the terrorism claims. So JACD, it will constitute a pool. It will collect the terrorism premium from all these 4 companies and it will constitute a fund. This fund, it will be reinsured with proper excess of loss covers. And then this fund will be redistributed to these actual public sector companies. So what will happen is New India's risk will be shared with National, Oriental's risk will be shared with New India, and United's risk will be shared with Oriental likewise. So this effectively redistributes the risks. In case of loss faced by one company, the loss will be mitigated by getting the claim from all these 3 companies. Moreover, if there is a unfortunate situation where all the 4 companies they get huge quantum of claims, at that time this protection given by excess of loss cover for the pool, it will kick in and it will pay the claim. Then we will move to captive. So this captive company is also known as a slave company. These companies are solely created by one big organization to transact reinsurance or insurance transactions of that company alone. In India, we can say we have one common word called conglomerate. So these conglomerate companies, they will be having presence in all the sectors. In India, we can take example as Tata. Tata will be having salt. Tata will be having manufacturing automobiles. Tata will be having IT systems. In fact, we were once a Tata's company. So these kind of companies, conglomerates, they will be constituting a captive company, which will be solely transacting the insurance business of their own parent. The advantage of this captive is that, for example, if this company, this conglomerate has to transact business with any other insurance company, they have to go through all these queues or they have to go through all the procedures. They'll be losing out the commission portion, which will be earned by the intermediaries while placing these risks. So when this captive company is formed, all these processes will be mitigated. There will be no expense in terms of reinsurance or insurance commission. The company, since it is a captive, it will be purely deciding what is the rate to be charged to give the pure protection. All these things are favorable in terms of captives. And one more thing, this captive company is formed certainly in tax havens. Tax havens in the sense, certain countries in the world, they won't tax insurance or reinsurance revenues and reserves, much like other markets. Common tax havens are Bermuda, Singapore, Swiss. These are the places where most of the insurers or reinsurers will like to open their offices because the taxation aspects are very much lax in these countries. So that is captive company. Then this ART itself has other forms of reinsurance in its pocket. So these new forms of reinsurances, first I'll begin with multi-line, multi-year package. This is very simple because the name itself suggests that it is a multi-line policy and it spans for multiple years. It can be very much compared to a shopkeeper's package or householder package of New India, where we are providing package covers for certain group of customers in order to avoid cumbersome tasks, in order to avoid gaps in coverages. Similarly, instead of getting reinsurance cover separately for separate LOBs, the companies can go for multi-line and multi-year package policies. The advantages of this MY package is that good years, in terms of loss, certain good years will balance out the loss of the bad years because we are taking coverages for multiple years, say 5 years. So what will be happening is during first 2 years there will be not much of claim quantum outgo. So the premium would have been saved by the reinsurer in these years. On third year there might be a catastrophe risk. This saved premium can be utilized for paying claims on the third year of for that catastrophe. These kind of advantages arise. Just because this kind of advantages arise, these insurances are somewhat lower in cost compared to traditional reinsurances. Moreover, the advantage to the insurer is that it gets a zero gap in coverage. There is a reduced negotiation and administrative costs. all will be done in one go, and they will be getting the coverage in one go. And in case of any risks, there will be protection available without any gaps. So that is the advantage of multi-line and multi-year package. Then one more form is multi-trigger policy.
Sir, who is
So widely, yes, sir. Yes.
Who is the owner of the multi-line and multi-year package?
So these multi-line and multi-year package policies are offered by the traditional reinsurers. These traditional reinsurers like Swiss Re or Munich Re, they were used to the older reinsurance forms. Now they have moved on to these forms. How New India is providing shopkeepers policy, at the same time New India is providing fire insurance for specific occupancies. Similarly, reinsurance companies, they provide standalone reinsurance. At the same time, they are also providing multi-line, multi-year package. For that matter, I'd like to inform that all these ART products have been now available with the traditional reinsurers itself, because they have found the potential in these products, and all these traditional reinsurers, they have jumped into this bandwagon, and they are providing all kinds of ART support. There are no specific ART companies who are providing specialized covers or like that per se. So I'll move on with multi-trigger policy now. This multi-trigger policy is very much popular in these new forms of reinsurances, because we commonly call it as a double trigger policy. And the operation of this is somewhat similar to hedging. This multi-trigger policy, how it will work is, there will be two triggers. Traditionally, what happens is there will be one trigger for an insurance policy. That trigger will be loss occurrence. When a loss occurs, you will pay the claim. That is the trigger. But in this multi-trigger policy, there will be two triggers. So these triggers can be customized at the time of taking the policy. These triggers will be fixed in sector wise. For example, there will be one insurance trigger and there will be one financial trigger. So how this will work? So this insurance trigger can be fixed like when there is a catastrophe event and the power station completely gets disrupted. This will be an insurance loss. So this will be kept as one trigger, insurance trigger. Second trigger will be on financial market. So whenever the interest income or whenever the return on certain reserves or certain funds go above a threshold, say 10% or 12%, it will be fixed at the time of the contract. It will be considered as a second trigger. So when this policy will pay claim is that both these triggers should be happened at the same time. Only at those times, this policy will come into effect and it will pay the claim. Let's say if there is a catastrophe event and the power station gets completely disrupted, but there is no much movement in the investment market, and the investment investment returns hasn't moved above 10%, then this policy won't pay anything. But when there is a catastrophe event, the power station gets disrupted, and at the same time, the investment markets were having an upward trend, and the investment markets were giving returns above 10%. When both of these events occur, these reinsurance policies will trigger and they will pay claim. So you might find like it might sound a little bit confusing at the beginning, but the origin of these policies came because these are very much cheap to procure. Why cheap? Because these policies won't pay on one trigger, they'll pay on two triggers. So the probability of happening of these two triggers at the same time is much rare. So in that way, the reinsurance company benefits in terms of getting lower losses. Only when these two triggers are happening at the same time, the reinsurance company will come into the picture and it will pay a claim. So that is multi-trigger policy. This can be designed in multiple ways. In fact, this multi-trigger policy is a tailor-made policy. A milk factory can design a multi-trigger policy and get a coverage. Whereas when there is a earthquake, the demand for the milk rises. So both of these events, when occur together, they are eligible to get a claim. Likewise, multiple concepts can be done and conceptualized, and these covers can be designed. That is the multi-trigger policy. Then I'll move to contingent capital. Contingent capital is very simple form of alternate reinsurance.
Sir, please repeat financial trigger once again.
Multi-trigger, right now?
Financial trigger.
Financial trigger. Okay, so financial trigger will be as simple as index or the share market or a particular investment fund breaching certain investment barriers. Let's say a certain mutual fund, when it exceeds the returns of 10%, we'll be considering it as a trigger. For the sake of clarity, I'm giving you an example in the terms of mutual funds. Or you can have it as a gold. Whenever gold crosses 5% of growth in 1 week, you can consider it as a trigger. So that is how this financial trigger works. We will take a financial market instrument and we will have a limit. Whenever the instrument breaches that limit, we will be considering it as a trigger. That is how the financial trigger works.
Sir, does it has to some correlation between the insurance trigger and financial trigger?
Definitely, ma'am. The insurance trigger should happen at the same time. The financial trigger should also happen. Both of these events should occur in one concurrent time so that the multi-trigger policy will come into effect. If
No,
only
no.
one
I
trigger
mean to
happens,
say, just you gave the example of the milk industry.
yes, ma'am. Yes.
Suppose there is any loss, and at the same time, you have given the example of the gold industry where the gold should not increase by 5% within a week. Now, if there is a loss in the factory, milk factory, and
Yes.
gold is also increasing at the same time, can these two triggers be considered together?
Yes. You have to consider these two triggers. When both of these triggers are satisfied, the company will pay for the loss of the milk factory in this
So this
example.
will be customized, tailor-made. Means this
Yes.
trigger you
Yes.
can decide at the inception of the policy.
Yes, ma'am. It is fully tailor-made policy. There is no standard policies in these lines. It is a fully tailor-made policy, and the
Okay.
terms of these triggers can be purely customized.
Okay. So there is no restriction as such that you are in particular industry, so you cannot financial trigger should be connected with that industry or something like that.
No restriction like that,
Like
ma'am.
you
No
are in a
restriction like
power
that.
industry, so it should be related to the stock movement of your industry, power sector only, not
No,
necessary.
nothing like that. Nothing like that. Nothing like that.
Okay. Thank you, sir.
You
Thank you,
can,
sir.
for example, you can club a catastrophe event with the power industry. Both are not relevant, but when a catastrophe occurs, the power industry suffers. So, like that, you can design triggers. There should not be
Okay.
any necessity for correlation.
Okay. Thank you, sir.
Okay. Okay. So I'll move with contingent capital. This is a very simple form of alternate reinsurance method uh, because the execution of this method is very easy. Just like this is as simple as getting a loan from a bank. But getting a loan from a bank, what normally happens is when a company plans to establish a business, they approach a bank, they get a loan, and they establish a business. Instead of this method, we are approaching this in a reverse way. So what will happen is the insurance company, they'll go and find a reinsurer, they'll execute an agreement. This agreement will state that whenever a loss mentioned in the agreement, when it happens, the reinsurance company, what it will do is it will provide capital for this insurance company to satisfy its claims or to satisfy its capability. That is called contingent capital. The name itself signifies when a contingency occurs, the company will receive a capital. This capital might be provided by a reinsurance company, or it might be even provided by some financial institution. It is just a pure bond agreement where the bond states that when a certain event occurs, I will provide you a capital for you to stay afloat instead of going sunk. It's as simple as that. So that's contingent capital.
So this is similar to
I'll move.
cash loss settlement.
Yes, you can have that. That is a very good analogy. It is very much similar to cash loss settlement, whereas cash loss settlement is one of the benefits available under a reinsurance. You can consider the cash loss settlement as the main product itself. Whenever a contingency occurs, this cash loss benefit will be provided by the provider. So in this ART, we commonly call these reinsurance providers or the coverage providers as provider in simple term. So the provider will provide you a loss quantum whenever a said contingency occurs. Shall I move to finite risk? Okay, I'll move to finite risk. Okay, so finite risk. Finite risk is a very recent kind of development in ART, and it works on a experience account and funded account basis. I'll explain this finite risk mechanism in the next slide. So let's consider an example for understanding of this finite risk better. So there is a contract executed by the provider and the insurance company. So the contract states that the period of contract is 3 years. The insurance company will pay annual premium of 10 crores to the provider. The provider will give a maximum reinsurance support of 5 crores. So this is the contract term. Now let's go and see how this works. So this is a 3-year contract. The insurance company on total of 3 years would have paid 30 crores as a premium. So this premium collected from the insurance company it will be credited in an experience account. This experience account will be operated by the provider. So this experience account will get inwards from the premium, and any investment incomes from these premiums will also be added to this experience account. If any loss occurs in these 3 years, that loss will be paid by the provider from this experience account. So we'll take two scenarios. If a loss for the total of 3 years is 28 crores, then what happens is this company, the provider, it already has this cushion of 30 crores. Whenever a loss occurs, it can just take this amount and will pay to the insurance company. So at the end of the 3rd year, when this total loss is below 30 crores, say in this example, 28 crores is the total loss for the 3 years, then the insurer will get back his 2 crores. So you might get a doubt that what is the advantage for the provider in this agreement? So see, these are multi-year policies. So whenever a premium of such a huge quantum will be credited into the experience account, this premium will be prudently and even shrewdly utilized by this provider to get maximum investment returns. And that investment returns will be the only margin for the provider. So at the end of the 3rd year, if there is only 28 crores loss in total, the insurance company will get back its 2 crore. However, let's consider the alternate scenario. If the losses for the 3 years is 34 crores in total, then what happens is the company itself, the provider itself, will be having only 30 crore in this experience account. So this 30 crores will be extinguished completely by paying claims. So there is additional liability of 4 crores. Now this maximum reinsured risk of 5 crore, this term, it comes into play. Whenever a finite risk contract is entered, there will be a reinsurance protection available for this experience account for a certain extent. So in this case, we have considered the contract as 5 crore reinsurance availability. So when this loss exceeds 30 crores, up 35 crores, the provider will be providing the support. Here the loss 34 crores. So 30 crore, it will be just taking out from the experience account, it will pay to the insurer. And another 4 crore, it will provide as a reinsurance payment. So this will be available for a maximum of 5 crores. So the most of these losses, when you see, are paid from the pre-funded premiums. That's why it is called as finite risk. Yes, ma'am. Yes.
But sir, here they have not given any share of premium to reinsurer. All 10 crore they have put in one account.
Yes, ma'am. Here, instead of reinsurer, you have to consider the company as provider. That is the company. The provider is the company that provides the support.
But what share they have
who is a
given
provider
to
here?
provider?
Yes,
What share they have given?
What, ma'am?
What share of premium they have given to provider so that they can
Yes,
give back?
yes. What
The provider
how this
is a
thing is
link between insurer and a reinsurer. Who is the provider in this case?
Yes, for easy understanding, you can consider here the reinsurer will be termed as provider. The person is same, the name is different. Instead of calling him the reinsurer, we are calling him the provider. And the insurer is for ease of understanding, let's consider New India Assurance as the insurer. So New India Assurance approaches Swiss Re. Here Swiss Re is the provider. So New India Assurance approaches Swiss Re and enters into a finite risk agreement. So New India Assurance, what it says is that I'll pay 10 crores every year to you. Whenever a claim occurs, I'll come and ask you for payment. So Swiss Re, it accepts this agreement and it creates an experience account. So whenever New India credits premium, Swiss Re will take it and put it inside the experience account. And simultaneously, Swiss Re will be investing this account properly and promptly across the global markets, and it will be receiving the interest income. This interest income will be solely pocketed by Swiss Re. Our original premium share, 10 crore per year, it will be intact. So whenever a claim occurs, Swiss Re will pay out from that premium account itself. So if there is a bad year where the loss is exceeding this 10 crore on the first year itself, the Swiss Re, what it will do is, it will give you 10 crores. In addition, if there is, for example, if there is a 12 crore loss in the first year itself, the Swiss Re would have received only 10 crore. So it will pay the 10 crore to New India Assurance, and the excess of 2 crores, that excess 2 crores, it will pay as a reinsurance payment. The provider is providing two kinds of support. One, it's just taking the premium and giving it back to you. And two, it is giving you a reinsurance protection to a small extent. Am I clear, ma'am?
Hello, excuse me, sir.
Yes, sir. Yes, sir.
Yes.
Sir, for this additional 5 crore reinsurance, that provider has to pay some premium from where that he will pay, they will pay.
Okay, sir. I think you're still confused. This provider is the reinsurance company. So reinsurance company will not pay anything for as a premium. Reinsurance company will solely pay claims. New India Assurance is the insurer in this scenario. So New India Assurance, it won't pay any extra premium. The reinsurance company solely earns by the investment income of this premium. Because, for example, I have given you 10 crore as a quantum, but in real life, what happens is a company will be transferring hundreds of crores per year to a reinsurance company. So the reinsurance company will just keep this inside its experience account and it will invest effectively. It will be easily gaining 5 crores or 10 crores per year out of this hundreds of crores. That 5 or 10 crores earned will be solely pocketed by the reinsurance company. That is his profit in this finite risk contract. He will not be getting any separate premium from the insurance company. He will just get the investment and income and he'll be pocketed and he'll be satisfied with that income.
But what is the benefit
risk
of
is very less.
insurer? He is giving all 10 crores to the provider. So what is the benefit he is getting from taking this business?
So the benefit what he arrives here is, for example, let's consider there is no this finite risk contract. There is a 10 crore premium income received by the insurance company originally. When the claim occurs, up to 10 crores, the reinsurance company can comfortably pay the claim. But even for that 10 crore, the reinsurance company will be having management expenses which it have to meet out. So let's consider like 2 crores is the management expense for the insurance company. So up to 8 crores, the company will be comfortable to pay claims. Once the loss breaches 8 crore, the company will be in a difficult position. Somehow it will meet out 9 or 10 crores of loss. But when the loss even deepens and when the loss aggregates to 13 or 14 crores, the company will be at the verge of bankruptcy. So instead of that scenario, when they enter into finite risk contract, what will happen is there will be protection over and above the premium they are paying. So even if the loss breaches the original premium it has paid, it will be getting some amount of protection from the reinsurance provider. That is the benefit for the insurance company. And one more main thing is we have to consider the alternate scenario. Let's say for the 3 years, there is no claim at all. In original reinsurance contract, what will happen? If there is a claim, reinsurer will pay. If there is no claim, the premium given to reinsurer is that's all. It is gone. We will not be getting it back. But finite risk has the advantage. When there is no claim at all for the 3 years, this 30 crores will be completely returned back to the insurance company. That is the attraction of the finite risk contract. That is why most of the companies are preferring this finite risk contract.
This that is the investment scenario is the premium for the insurance company.
Can I have it clearly?
Vishnu sir, we will take all the question at the last. I request you.
Yes, sure. Okay, now we'll move on to financial reinsurance. Sir, I don't know who has doodled all across the screen. Is someone having the access for doodling across my screen?
Yes, sir, visible, sir.
Okay, I'll move on. Okay, the other form of ART is financial reinsurance. The financial reinsurance has 3 types of concepts. One is time and distance policy. This time and distance policy are primarily preferred in case of long tail liability claims. Again, we come back to insurance company example. An insurance company is facing a suit claim. This suit claim is due to certain product liability. And the insurance company is having a reasonable estimate that the award will be given by the court in a span of 3 or 4 years from today. Based on the internal advocates panel and all, they are getting a reasonable estimate that this claim will be awarded by the court in a duration of 3 or 4 years. So now the company has to do 2 things. Even though the claim is going to be paid at the end of 3rd or 4th year when the award comes, the company should prepare the claim quantum. But this claim quantum, when it is just kept as a loss reserve with the company, it is not going to earn anything. It is just going to be locked there And whenever the award comes from the court, the insurance company will have to take out this loss and it will have to pay it to the client. So instead of just keeping this amount in without making it perform any much, just simply locking this amount, it was disturbing to these companies. So that gave birth to the time and distance policy. What the company will do is, it will find a reinsurance company and it will say that I am having a liability claim and it will take at least 4 years based on my estimate for the claim to be settled, the award to be provided. So I am having a span of 4 years to settle a claim. So what I will do is, I am going to invest this amount somewhere and I am going to earn an investment income. But there might be a rare scenario where the court might be advancing the award. Instead of 4th year, the award might come on 2nd year. So if I have invested my amount and at the time of the award, if I am not able to withdraw the funds to pay the claim, it is going to be a bad situation for me. So what you have to do, the insurance company will speak with the reinsurer that if by any case the award is advanced, you pay on behalf of me, you pay the claim. For this, I will give you a premium. This is how it will work. So the reinsurance company will come into the agreement. It will say that I will collect a premium from you. I will be watching when the award gets honored by the court. Once the award is given, I will pay if and only if it is occurring before 4 years. If it is occurring after 4 years, you pay with the award. I will just pocket the premium. I will move on. So that is how this concept works. The insurance company benefits by investing the amount. Instead of just solely locking it inside a loss reserve, the insurance company will be able to invest it and gain some income until the award is provided. That is time and distance policy. So the long tail claims, they are reinsured for a premium, and the difference between this claim quantum and the premium is invested to gain investment income. That is how this time and distance policy works. Next, I will move to spread loss. So spread loss, it is again a precluded concept. It has been avoided in multiple countries because it is not felt as a proper reinsurance protection management system. Rather than it is felt like a gambling kind of a system. Hence, this spread loss has been precluded in markets. But I'll explain how this operates. Here also, two companies will be entering into an agreement, but the reinsurance company here will be operating a bit differently. So whenever the books of the insurance company becomes negative, the reinsurance company will come in and it will put in capital inside the company. Just like how government, it infuses capital inside the insurance company who is facing a loss for multiple years. The government has to step in. It has to put in some capital infusion so as to float the company back. In a similar way, the reinsurance company will step in and it will infuse certain capital every time the book of the insurer goes to the negative side. So for this, he will be collecting a premium, and even to an extent where he will be getting the ownership of the insurance company to a certain extent. So all these felt like pure capital market transactions. That's why the spread loss concept has been banned, or rather it has been precluded in multiple markets. Primarily, European market was having this kind of system, but European market has now completely put off this kind of spread loss system. Now we'll move to loss portfolio transfer. This loss portfolio transfer is very much used in all the reinsurance arrangements. So I'll explain how this loss portfolio works. The insurer will transfer a loss portfolio to a reinsurance company, and it will pay a premium, and it will relieve itself from any further liability. I'll show you the working of this loss portfolio transfer as an example. Let's consider a motor LOB. Motor TP is the LOB. There is an outstanding claim as of today. The insurance company is having an outstanding claim of 100 crores in motor TP. The company is feeling that this 100 crores might even worsen based on the developments. So what it will do is, it will find a reinsurance company first. The insurance company will search for a reinsurance company to take over this loss portfolio. It will be finding a reinsurer who is willing to take over this 100 crores of loss quantum. So for taking over this 100 crores of loss quantum, he'll be paying 90 to 95% of this portfolio as a one-time premium. So for this 100 crore, he'll be paying around 90 to 95 crore as one-time payment to the reinsurance company. Let's assume 95% is the agreement between the insurer and reinsurer. So 95 crore will be transferred by the insurance company to the reinsurance company. the reinsurer accepts this loss portfolio transfer, and it also puts an upward ceiling stating that I'll take over your portfolio. I'll give claims up to 100 crores in motor TP of your portfolio. But if there is any worsening experience, I can go up and I'll provide up to 110 crores. But any awards that exceed more than 110 crores, for example, at the end of the year, when the outstanding claims exceed 110 and it will become 120 crore, what the reinsurance company will do is it will pay 110 crore and that another 10 crore excess will be reverted back to the insurance company. So that is the outcome of the arrangement. Scenario 1. If final claims total to 90 crore, the reinsurance company profits because it has received 95 crore as one-time premium from the insurance company. It has received only 90 crore award from the motor TP LOB. So 5 crore is pure profit for the reinsurance company. There is a second scenario. The final claims total to a quantum of 105 crores. Now what happened? The reinsurance company has only received 95 crores. The reinsurance company will be paying the 95 crores and in addition another 10 crores to meet out the total loss. 105 crores will be paid. Here the insurance company profits because it has paid only 95 crore. At the same time, it has got a 10 crore additional cushioning. The insurance company is relieved from this additional liability. Scenario 3. If the final claims total to 115 crores, what will happen is the agreement is clearly mentioning a upward ceiling of 110 crore. So the reinsurer will pay 95 crore, that premium he have received, he will pay that 95 plus another 15 crore, that is up to the 110 crore upward ceiling. It will pay 95 plus 15, 110 crores. Then another 5 crore, that is in excess, it will be reverted back to the insurance company. So anyhow, this insurer is now in a profitable situation because when you think of, he has only paid 95 crores as the premium to the reinsurance company. Even though there is an overflow of 5 crores, he is safe because he has to bear another outgo of 5 crores and that will be all. He has efficiently got 15 crores of protection from the reinsurance company. So this is how the loss portfolio transfer works. Next, I'll move to catastrophe modeling.
Sir.
Catastrophe, yes, sir. Yes.
Sir, please explain loss portfolio transfer with one
Sir,
more example.
how it is different from stop loss?
Okay, I'll explain, sir. Stop loss, it is you can very much have this analogy similar to what aggregate excess of loss insurance. But the thing is, these stop loss or aggregate excess of loss reinsurance, they are kind of developing products in sense. There will be an agreement entered before the start of the year, and the reinsurance company will be monitoring the development of that LOB throughout the year. When the loss exceeds a certain threshold, the stop loss will trigger and it will pay. But this loss portfolio transfer is reverse. This company has already worked for say some 2 or 3 years, and without any reinsurance protection, they are able to sustain. And at the end of the 3rd year, now they are in a situation that they have got 100 crores worth of outstanding claims in TP. So here the cover reinsurance protection we are taking is after we have made the losses. Whereas in stop loss, the reinsurance would have been taken much before the beginning of the financial year. After the taking of the cover, the financial year commences, and throughout the financial year, whenever there is a exceeding stop loss ratio, the reinsurance company will be coming into the picture. But loss portfolio transfer is reverse. We have already made loss. After making the loss, we are approaching a reinsurance company, asking them to take over this loss. So you can find this to be what is the reason to go for loss portfolio transfer. This is very much suitable for a company who decides to completely scrap an LOB here on. For example, if a company is deciding to completely move away from a motor business from next year onwards, they are trying to purely focus on property and health LOB. They are going to scrap motor TP. So what will happen for that company is, if they are not going for LPT, loss portfolio transfer, this outstanding claims will be hunting them every year. Even though they will be not getting motor premium from next year, they will be having this 100 crores of liability with them. So instead of pulling this liability with much strain, they can simply write off this LOB and they can get a LPT, loss portfolio transfer, from a reinsurer. So that is how this LPT will be useful for a company. So primary difference is loss portfolio transfer will be taken after the loss has occurred, whereas stop loss or aggregate excess of loss will be taken before the commencement of the financial year. That is the primary difference.
So just one small doubt. For example, if 100 crore loss is already there and they are paying only 95 crores. So why somebody will take that kind of portfolio in their account? If already 100 crore loss is there and then they are paying only 95 crores.
Okay. So this 100 crore loss is outstanding loss. So this outstanding loss will be having multiple things. There will be IBNR, incurred but not reported. There will be IBNER, incurred but not enough reported. So this 100 crore, this number will be arrived by the insurance company after adding reasonable upward factor of safety. So originally there will be a loss of some 60 or 70 crores. After applying this IBNR and IBNER, they would have extrapolated it to 100 crores. The underlying loss will be some 60 to 70 crores. So that is how they will be arriving for an outstanding claim quantum. On that, they will be paying 90 to 95%. The reinsurance company will also very much have an idea how much IBNR reserves they have deployed, how much various correction factors they have deployed. They will be getting all these data. Only after getting these data, they will be accepting the loss portfolio transfer. So the reinsurance company will know there is a probability to completely close all the claims at 70 crore mark. Then pocket the additional 25 crores completely as a profit. There may be adverse probability where in a rare chance he has to exceed the premium, he has to pay 100 or 105 crores. So that is how this LPT works. This 100 crores will be not completely on exact account books. There will be multiple provisions. At the same time, there will be multiple adjustment factors. Only based on that, a company will arrive for outstanding claim. And that's why the reinsurers will be willing to take this loss portfolio transfer.
Got it, sir. Thank you.
Okay. Catastrophe modeling. So catastrophe modeling is very much useful to procure catastrophe excess of loss. I'll touch upon the excess of loss covers in the later part of the PPT. So there is a coverage called catastrophe excess of loss, which is protecting an insurance company in the event of an accumulation from a catastrophe. So these catastrophes are not very much recurrent in nature. Recurrent in the sense they will be recurring, but there will be certain time gap between the recurrence of these catastrophes. So for an insurance or reinsurance company, there will not be not be having enough historical data to precisely arrive at the rate for providing a catastrophe cover. So what happened until development of this catastrophe or CAD modeling is that these catastrophe covers are more often provided as a bundle. When a company procures some excess of loss cover, the company will be just using catastrophe excess of loss cover as a free cover inside the regular excess of loss cover, or it will be used to attract the insurers by saying that we are providing this cover, we are providing this as an additional benefit to you. So that's how this catastrophe cover was treated either two. But when a catastrophe occurs really, when we have not got any premium, the reinsurer will be bearing the brunt. He will be affected badly at the time of catastrophe loss because he wouldn't have got charged enough premium, or in most of the cases, he would have given the cover for free. And when a claim occurs, he will be very much feeling the suit. So this catastrophe modeling came into existence because of this kind of scenarios. Now, with the help of this CAD models and computer graphic models, we are able to simulate the situations. We are getting multiple data from multiple sensors across the world. We are having GPS sensors. We are having earthquake sensors placed across the world. And all the data gathered from these sensors, they are being put inside databases. And this data warehousing concepts and all are purely utilized to store these data. When these data are properly executed, an insurance company or a reinsurance company can have an idea when an earthquake occurs in certain location, what will be the outcome of the earthquake, what will be the financial consequence of the earthquake. They can have a better idea by simulating these scenarios. So this catastrophe modeling is done in 3 modules. These are purely softwares. Like how we are having graphics software or movie editing softwares, like that. This catastrophe modeling software is a simple software. It is working based on the gathered data across the world. So this software will have 3 modules: hazard module, vulnerability module, and exposure module. You might be getting some exam-oriented questions on what the hazard module does, what the vulnerability module does. That's why I wanted to include this inside the presentation. So hazard module, what it will do is all the events, it might be an earthquake, it might be a cyclone, these events will be simulated by this hazard module. So this hazard module will be having all the data necessary to create a artificial earthquake. in a system environment. It will create an artificial earthquake in a CAD model, and it will determine the frequency and severity of that particular hazard. It might be earthquake, it might be a cyclone. Then this hazard module will then communicate with vulnerability module. So what the vulnerability module does is, it will quantify the damage from an event based on the building or based on the city characteristics. For example, as an interesting analogy, I can put on this example. We all read news about cyclones occurring often in USA, because it is a region that is prone to be affected with huge intensity cyclone. But we will be not facing that huge cyclones in India. By the help of this catastrophe modeling software, we can run a cyclone, and we can also give the data of a city in India, and we can compare what if that cyclone, if it occurs in a city in India, what will be the outcome. Like that, we can run the module and we can get the data. For example, a cyclone, when it is running inside the city of Mumbai, or when it is running in the city of Chennai, we can give the topography of the city, we can give the intensity of the cyclone, and we can get the data. How much of the city's properties will be affected? How much will be the accumulation in terms of the property and in terms of motor vehicle accident, motor vehicle claims, and how much will be the combined losses faced when a particular hazard occurs in a particular city. So these two modules, they provide data to the exposure module. So this exposure module, what it will do is, it will purely measure the loss in terms of money. Hazard module, what it will do is, it will simulate it will simulate an event, and it will determine the frequency and severity of an event. Vulnerability module, it will just find out what will happen to the city, what will happen to the building, what will happen to the insured property. And with exposure module, it will provide the data regarding how much loss quantum is expected when these two events occur. So that is how this catastrophe modeling software works. Then I'll move on to credit rating topics. So credit rating, we all have an idea about credit rating. It is an opinion of the financial strength of an insurance company or a reinsurance company. So it is like a grading system. Credit rating is a grading system which is awarded to a company. This credit rating will be given to a company based on its capability to meet its policyholder obligations. So there are two obligations. One is policyholder obligation. Another is the shareholder obligation. So policyholder obligation purely means whether an insurance company is able to pay a claim for a coverage given under a policy to an insured. That is the policyholder obligation. A shareholder obligation is on the other side, whether the company can pay the shareholder profitable dividends. So this credit rating, they will take into account only policyholder related transactions. So whether a company is able to satisfy the claim without getting financially strained, whether they are capable to give the cover in terms of when there is a claim event, that is taken into consideration while giving a credit rating. So this information about a company's financial strength, information about the company's capability to meet out the claim, they are gathered from the insurers or the reinsurers themselves. Or if there is no data available from the companies themselves, it will be available. It will be taken from some certain other genuine sources that are considered reliable. So what we have to get into understanding is that these credit ratings, they do not refer to an insurer or reinsurer's ability to meet non-policy obligations, but it is solely reflecting the policyholder obligation. So this credit rating will be given to the companies. Then there is on another spectrum, there is sovereign rating. Similarly to the companies, we can also quantify certain countries. A country will be in a strong position to meet out its debts. A country will be in a weaker position because of the inflation, because of other geopolitical issues. Yes, certain countries will be in a weaker position to meet out the debts of the country. So the rating system will be given for the countries having good and bad financial statuses. That is called a sovereign rating. So why these two ratings come into play? For example, New India Assurance is planning now. Now we have got this war on land cover, which has been launched recently. So now what we are doing is, we want to give this war on land cover. For that, we have to approach a reinsurance company. So while approaching the reinsurance company, we will be having certain expectations from the company. We have to see whether that reinsurance company is strong enough for us to provide backing when there is a real life war scenario and when there is a requirement for the company to get claim from the reinsurance company. So in that case, we need credit rating, because credit rating helps us to segregate the insurers or reinsurers who are having the capability to provide this cover. But while selecting a company, we also have to take into account the sovereign rating, because whatever strong strengths the company will be having, the company is operating inside a country. When the country itself is becoming bankrupt, let's consider this 2008 scenario in USA, where all these companies went into bankruptcy. There was a major turnaround on the dollar related scenario. So what will happen is when the country itself is sinking, there will be no gain with the company, even though if it is having very rosy ratings. So always the sovereign rating takes precedence. It is always superseding the credit rating of an individual company. So when we are approaching a reinsurance company, we have to take into account two things. We have to first see which country the company is based on. Then we have to identify what is the sovereign rating of that country. Secondly, we have to see what is the credit rating of that company. And when both of these are satisfactory, we can go and negotiate for a coverage with that particular company. So there is a system called credit watch, because these credit ratings, they are not one-time operations. They are constant re-evaluation operations, because it has to be constantly re-evaluated so that these credit ratings reflect the real life picture. Otherwise, it will be very much skewed and the data might be misleading also. That's why there is one feature called credit watch. This credit watch is purely done when there is a expectation about either a country or a company to be having either upward or downward performance related movements. So when a deviation from an expected trend occurs, for example, if Swiss Re has been taken and we are finding that Swiss Re is constantly developing, and suddenly because of certain laws or because of certain regulations, there is an anticipation that Swiss Re might be limiting certain kind of coverages. So this will be creating a slight confusion among the investors and amongst the insurance companies who are getting support from the Swiss Re. So in that case, these credit rating companies, what they'll do is they'll put Swiss Re under credit watch. So this credit watch will be closely observing the company, whether it is going to progress, whether it is going to overcome the hurdle, and they will be assigning a tag along with the company's name. So it might be either positive or negative or developing. So when a positive tag is given in credit watch, it means that the company might be having a better development and the credit rating will be in upward revision possibility. But when the negative tag is given to a company, there is a possibility that the company is going to have a worsening of experience and the credit rating might be given a downward revision. And there is one more tag which is developing. So when a developing tag is given to a company, there is a possibility that the company is it might either move up or it might either move down. So when there is a very huge uncertainty, we will be giving developing tag. So this is how we will be knowing that the company is either going to flourish or when the or if the company is either going to have a near impending loss. It helps. The credit watch helps us to assess the situation somewhat closely. Okay, now I will jump into certain ARBI regulations. I hope I will not be boring you much, because these certain regulations will be useful as one mark questions in your exam. So first I will go into fronting agreements. So this fronting agreement is earlier considered as a ART method, but fronting has been completely banned. I'll explain what is fronting. Let's consider there is a new insurance company that is formed in India. This insurance company was formed by a particular person who is not having much knowledge in the insurance industry, or who is having a reputation of jumping across the boat. He'll be like certain personalities who will be having a reputation of beginning a company and suddenly selling it and moving on. So let's consider there is one such company newly started in India. So this company having this bad reputation, they can't go into the market and get premium, because people won't be interested to place business, because they will not be feeling secure to transact the insurance business with them. So in that case, this particular new company, what they can do is they go find an international reinsurer who is having very strong backing, who is having a very good name in the market. They can go and they can ask for a fronting agreement. So in fronting agreement, what the reinsurance company will do is it will put a clause, that is cut-through clause. It will be very much well versed with cut-through clause. I'll explain. So what the cut-through clause does is, there is a 3-point relation: insurer, reinsurer, insurer, and original insured. So this is the 3-point relation. So in a reinsurance agreement, there is no relationship between reinsurer and the original insured. That is a common known thing. When the cut-through endorsement, cut-through clause is invoked, the reinsurer can directly pay to the original insured by cutting through the insurer. So this is how a development company, they can enter into fronting agreement with a huge reinsurance company across the globe, and they can use it as a marketing material, stating that we have a fronting agreement with so-and-so company. So even though our name is not good, even though you have a doubt on our performance, you need not to be worried, because when you insure with us, the claim will be settled by the reinsurance company directly to you, even though if I am defaulting. So that is how this fronting works. So this provides undue advantage to these small companies. That's why IRD has banned the fronting agreement completely. Because in effect, the insurance company will act as a puppet for the reinsurance company. The vice versa concept might also occur. A reinsurance company who is planning to start its operation in India might find that IRD regulations are too strict to start business in India. So what they can do is, they can find a small insurance company in India. They can enter into fronting agreement, and they say that you don't do anything. You just be there present as a insurance company. Whatever business you transact, it will be transacted by us between the original insured and me, and you will be there for regulatory purpose. So these kind of acts are also done, and that's why fronting agreements are completely prohibited. Then regulations regarding life insurance retentions. So in life insurance, we have two types of policies in general: term life and other than term lives, that are endowment or money back, or any kind of policies that are having benefits other than pure term life. So in term life policies, we all know that the premium is very less, because it is a pure term protection. The insured will not get any amount back at the end of any particular policy period. So that's why the retention is somewhat lower for pure term policies. 25% is the minimum retention for pure life policies. So other than pure life policies, the life insurer will be getting premium, and it will be investing it. It will be getting good chunk of premium, and it will be investing and getting the investment income also. And that's why, other than pure life policies, the retention requirement is 50%. The company has to at least retain 50% of the premium for other than pure life policies. So that is the guideline given by IRDA in terms of life insurance. An Indian reinsurer. In India, there is only one Indian reinsurer, who is GIC Re, and GIC Re has to maintain at least minimum 50% as the retention of Indian business. So whatever Indian business has been procured by GIC Re, it should not completely go for reinsurance. It should at least retain 50% of the business, and the remaining 50% alone, it can go for reinsurance across the globe. Okay, then catastrophe modeling. We have earlier seen this catastrophe modeling and how it works. ERD has mandated that this catastrophe covers were earlier got in unreasonable rates and they were not viable. Now you have to give catastrophe modeling report when at the time of filing of the reinsurance program, because IRDA wants to check whether this rating of that catastrophe cover has been properly worked out. Because these catastrophe modeling techniques help the company to properly decide the rate. We use a term called payback method when it comes to deciding the rating of catastrophe covers. So what it means is, these catastrophe covers will be charged on the basis of how much premium and how long, if I collect, I'll be able to pay for a loss. For example, if I am collecting 1 rupees per year, there is a catastrophe event, and if I am supposed to pay 200 rupees for a catastrophe loss, then I have to collect 1 rupee for 200 years so that I can meet out this loss. So that is how payback method works. That is called payback method. This was earlier used. Now catastrophe modeling has taken over. It is providing precise data.
Sir, please explain this payback.
So payback method, what it is, how it will work is, there is no data as far as catastrophe is concerned, because we don't have historical data more than some few hundred years. But these catastrophes were as old as the origin of the earth. So we don't have enough data to precisely account the premium required to provide a cover. Because for other methods, we have this burning cost method and all, where we will be having experience of paying claims, and we'll be getting the burning cost data from the past 5 years or 10 years account, and we'll be fixing a premium. But in catastrophe, that is not possible. So what the company will do is, it will reasonably estimate, for a particular catastrophe, I might be able to pay a maximum of 100 crores. So for 100 crore, how much premium I have to pay? I have to collect 1 crore per year for 100 crores, 100 years, sorry, 1 crore per year for 100 years. So that is called payback method. The company can decide how long it might need to collect and how much it needs to collect. The company can decide, and based on that, he can price the cover. If a company is willing to stretch the cover long, he can plan for 1 crore per year and 100 years. Or if company is willing to not willing to stretch the loss much, he can collect 2 crores per year for 50 years. So that is how this payback works. They just come into a conclusion for any loss quantum payable, maximum loss quantum payable for a catastrophe, and based on that, they will reverse calculate how much premium per year I have to charge and how long I have to charge, so as to meet out one single catastrophic loss. That is how payback method works. Am I clear, ma'am? Or
Yes, sir. Yes.
yes, okay. Okay, the regulations continue. So reinsurance arrangements by the insurer. So any insurance company in India, they have to follow these kind of timelines for reinsurance program arrangements. So any company will be having a reinsurance department. So this reinsurance department will be structuring the reinsurance program. Once the reinsurance program has been structured, at least before 45 days from the commencement of the financial year, this program has to be submitted to IRDA. At least 45 days before the commencement of the financial year. Then, once the financial year has commenced, within 30 days of the commencement, this particular reinsurance program has to be filed with IRDA. First, before 45 days, we are presenting the data to IRDA. Once the financial year has commenced, within 30 days, we have to file the program properly with IRDA. And once this filing has been done, if there is any revision in this program done in the middle of the year, when this revision occurs, this has to be communicated to IRDA and filed with IRDA within 15 days of the approval of the revision by the board. So these are the timelines fixed by IRDA. You have to remember 45 days, 30 days, and 15 days. 45
Excuse
days is
me, sir.
prior to the commencement of financial. Yes, ma'am.
Sir, hasn't this 30 days been revised now as per regulation 2014? Do we have to remember the difference or we have to remember the new one only? It's 45
Yes,
days
you
now,
have
no?
to remember the recent regulation only. 2023 is also 30 days.
But now it's 45 days, sir.
45 days,
45
sir.
days is before commencement of financial year, ma'am.
After also
No,
it is
sir.
45.
Both the days are 45 days now.
Yes, ma'am. Sorry.
Before commencement is
So
also
both
45
both
days, and
together
after
45 days.
commencement of financial year is also 45 days now, as
Okay,
per new
okay, ma'am. Okay.
regulation.
Okay, fine. So you are referring to 2023 regulations, right, ma'am?
Yes, sir.
Okay, ma'am. Okay, I'll correct myself then. This is 2018 regulations. So there is a revision in 2023 regulation, it seems. Sorry. So it is 45 days now, right, ma'am?
Yes, sir.
Okay. So before commencement of financial year, it is 45 days. And again, after the commencement of financial year, filing has to be done in 45 days, right, ma'am?
Yes, sir.
Okay. And I'm sure this 15 days has not been revised. This is still existing. 15 days is the window given for any changes in the program.
Yes, sir. That is same.
Okay, fine. Thank you. Okay, now we'll move on to CBR, cross-border reinsurance. It is a terminology given in India. It is nothing new. Any insurance company who is having origin other than India, for example, Swiss Re or Munich Re or any other reinsurance company having their origin in outside countries, they are termed as cross-border reinsurers. So any company to be recognized as CBR, cross-border reinsurer by IRDA, for to be recognized as a CBR, they have to meet out a certain criteria. The criteria is that this particular company should have been at least transacting insurance or reinsurance business for 3 years minimum in their home country. So that is a minimum requirement. We can't go and approach a company who has established just a year ago and have a reinsurance agreement with him. So there should be a minimum of 3 years of continuous operation of that particular company in his home country. Then minimum credit requirements. So minimum credit requirements, there are two sides. This is bare minimum. There is one more side which is required minimum. So bare minimum is BBB. No Indian insurer should place a business with any reinsurer having ratings below BBB from S&P or any other equivalent agency. Then the home country of CBR. The CBR, when cross-border reinsurers are referred for reinsurance arrangements, IRDA prefers that CBRs who are having double taxation avoidance agreement in India, they will get the preference. So what is double taxation avoidance agreement? We have DTAA, double taxation avoidance agreement in certain countries. Thailand is one such country. I can explain for a clearer sake in automobile sector. What happens is when a particular automobile, say a car, has been imported from European country, UK, there is a taxation system in India which mandates 110% of the cost of the car to be charged as an import tax. So if a car costs 1 crore and it will be imported to India, it will be costing 110% higher. But there are certain countries who are exempted from this import taxes. Those countries are called double taxation avoidance agreement countries. So Thailand is one such country. Whenever an automobile is imported from Thailand to India, there is a lower tax bracket. It is not completely abolished, but it is on a lower bracket, say 30% or 45%. So this agreement is executed by India with certain countries in order to build favorable trade relationships between these countries. So those kind of countries who are having this DTAA, the reinsurers based on those countries are getting preference, because this insurance is inherently taxable system, and it is very complexly taxable concept. Insurance is, because the insurance company or reinsurance company will be having reserves, they will be having loss portfolios, they will be having premium transfer portfolios, multiple reserves and quantums will be maintained by the company, and all of these will be taxed by the country, because it is not getting any exemption from the taxation. It is not getting any exemption from the taxation. That's why we are preferring DTAA countries wherein this taxation related losses will be less. So IRDA mandates us to refer to CBRs who are having presence in DTAA countries. And moreover, the CBR has to satisfy the minimum solvency margin as specified by their home country for at least for the past 3 years. We have earlier seen that the company should be working in its home country for at least 3 years. Not only working, but it should also meet the minimum solvency margin set by that country for that 3 continuous years. Only when that kind of independence is provided by the company, we can approach them for a reinsurance arrangement. Then obligatory cession. Obligatory cession as of now is 4%. If there is any correction, you can chime in. 4% is the current obligatory cession mark. There is no revision as far as 2023 regulations is also concerned. Profit commission, which is given by GIC Re to the participants, is on 50% basis. So Indian reinsurer and ceding insurer. Whenever a ceding insurer provides a business to GIC Re, this GIC Re will pay profit commission on the treaty if it is profitable. So that profit commission will be shared on 50-50 basis. I'll explain the profit commission and super profit commission in the next slides. Categories of reinsurance as per the order of preference. So when an insurance company is willing to go for reinsurance arrangement, there is an order of preference that has to be satisfied. The first companies to be sought after is Indian reinsurers, that is GICD. Whenever an Indian insurance company wants to go for reinsurance agreement, it has to first prefer an Indian reinsurer. Only after an Indian reinsurer's capacity or willingness is not sought after, they can move to the second category, which is IIO. This IIO is IFSC Insurance Office. IFSC means International Financial Service Center Insurance Office. So this is set up in Gift City of Gandhinagar. IIO is regulated by IFSCA, which is an authority, IFSC authority, and it is not regulated by IRDA. So what this IFSC IIO is that this is certain specialized financial service center which provides reinsurance support. It is set up in gift cities because this gift city enjoys all kind of taxation avoidance, all kind of all kind of laws and regulations that promote easy international transactions and easy international reinsurance transactions. That is how this gift city is set up. So those IIOs, they get the second category preference. Then category 3. Sorry, I need to explain one more thing. Those IIOs who are retaining 100% of the business contributed to them inside India, they'll be getting the second preference. Third is those IIOs who might be getting premium from Indian companies, but they will be investing certain portion in India and also certain portion in outside countries. Those companies will be given third preference. And lastly, there will be other Indian insurers or CBR. You can go for reinsurance protection to another Indian insurance company also. For example, New India can go and seek reinsurance protection with Oriental Insurance. It is possible, but it is not possible in case of treaty. It is solely possible in case of facultative placements, because for treaty placement, there is no provisions given by IRDA. So within India, if there is a requirement to get reinsurance support from other insurance company, it can be done only for facultative placements. Then lastly, we can go for CBRs, cross-border reinsurers. So these Swiss Re or Munich Re, whoever, they are given the last precedence. This category of order is solely designed because we have to maximize the retention inside the country. That is why we are having this kind of category precedence. And there is also minimum capital requirement set by IRDA for these foreign companies who are setting up branches inside India. So those foreign reinsurance companies are Lloyd's India branches who are setting up branches inside India. They have to have a minimum capital of 50 crores. So the methods of reinsurance commission. Now I'll come back to the commission. So whenever a reinsurance,
kindly elaborate DTA.
Yes, sir.
Kindly elaborate DTA.
Yes, sir. DTA, Double Taxation Avoidance Agreement. Actually, India enters into this agreement with certain countries whom it thinks that it is much favorable to have business dealings with these countries, which will be helping to build the economy of India also. So those kind of countries, they'll enjoy a reduced tax slab compared to other countries who will be having higher tax slab. So those countries are called DTAA countries. That is, this particular agreement is called Double Taxation Avoidance Agreement. And simply that is why we are preferring these countries, because the tax rates will be much lower with these countries' transactions.
Thank you, sir. Thank you.
Okay. So we'll move on to the reinsurance commissions. So whenever a reinsurance transaction occurs, the insurance company will pay a premium to the reinsurance company. So this reinsurance premium, when the company receives, it will pay a commission to the insurance company. Just like how we insurance companies get premium from our agents and we are paying them commission. Similarly, reinsurance companies get premium from this insurance companies and they pay commission. So this commission can be paid in multiple ways. What is flat rate commission? Flat rate is just very much similar to our business, where we say fire lines will have 10%, motor lines will be having 15%, like that. One fixed percentage will be given, and that fixed percentage on that premium will be given as a commission to the insurance company. So this reinsurance commission is very much a big factor in consideration of placement of reinsurance agreements, because it is a huge quantum that is ceded to the company, and on that huge quantum, if it is some 20 or 30% of reinsurance commission when an insurance company receives, it is a much bigger support for him. So commission is an important angle in placement of reinsurance business. Then we go to sliding scale commission. Sliding scale commission is a variable commission. It depends on the loss ratio of the treaty. So this kind of commission is suitable only for treaties, because facultative reinsurance, what we do is we reinsure one single risk, whereas in treaty, we will be ensuring an n number of risks that are falling within the scope of the treaty. So whenever there is a loss ratio that is worsening inside the treaty, the reinsurance company will reduce the commission slowly. Whenever the treaty is going in a profitable direction, the reinsurance company will be giving more commission. That is how the sliding scale commission works. So it is inversely proportional to loss ratio. Sliding scale commission will increase when the loss ratio decrease. Then ORC, overriding commissions. There are two definitions for ORC, overriding commission. I'll explain one by one. So first definition is given in case of net rate business. So when a reinsurance business is transacted, what happens is the insurance company will always pay gross premiums to the reinsurance company. So what is a gross premium? This gross premium will be comprising all these expenses, procurement expenses, commissions, everything will be included in that premium. The entire premium will be paid to the reinsurance company as a reinsurance premium. When this kind of placement is done, it is called gross rates. But in certain cases, what we will do is, an insurance company, if it is receiving 100 rupees as a commission, as a premium, and it is having an obligation to pay 10 rupees as a commission. So what the company will do is, it will get 100 rupees inside, it will pay the 10 rupees as a commission, and the balance 90 rupees. That 90 rupees it will use to pay for reinsurance premium. If it is done in this manner, it is called net rate, original net rate transaction. ONR is the abbreviation used for this, ONR, original net rate. So this kind of rating, this kind of transaction is done in certain LOBs. You'll be aware it is done in marine and aviation LOBs. The business will always be booked on the basis of net rates. So in these cases, there is no, because the insurance company has already paid for the commissions, it is not going to pay for commissions by receiving the reinsurance commission. That's why what happens is, reinsurance commission will also be lower when the business is done on net rates rather than gross rates. So what you have to take away is, when a business is transacted in gross rate, the reinsurance commission will be higher. When a business is transacted in net rate, the reinsurance commission will be lower. This net rate transaction will give a reinsurance commission, which is called as overriding commission, ORC. This is one kind of definition for ORC. But there is also another definition, which is also called as overriding commission. This will explain you clearly. So reinsurance commissions that are received from inward retrocessions, they are also called ORC. So what is this inward retrocession? There is a ceding insurer in this example. So the ceding insurer, what he will do is he'll go for reinsurance protection with the reinsurer 1. So the reinsurer 1 has got the premium from the ceding insurer. He has given the protection. Now what happens is the reinsurer 1 is feeling that this he needs further protection. So he goes for a retrocession. So he approaches another reinsurer and he gets the retrocession protection from reinsurer 2. Now, this reinsurer 1, he has received the business from ceding insurer. For this business, he would have paid reinsurance commission. Reinsurer 1 would have paid reinsurance commission to the ceding insurer. Whereas the reinsurer 1 will also get reinsurance agreement from reinsurer 2. Now, the reinsurer 2, he will pay a commission to the ceding insurer. Why he will pay a commission? Because the business placed by the reinsurer 1 was originally procured by ceding insurer. So, in a way, the ceding insurer is the reason why the reinsurer 2 got the retrocession business. That is why he will pay one more commission. Over and above the reinsurance commission, he will pay a overriding commission to the ceding insurer. But this overriding commission will be very low. This, for example, this reinsurance commission might be in the range of 30%, but this overriding commission will be in the range of some 5 or 6%. This is because ceding insurer was the reason for procurement of the business, and that business was provided as a reinsurance business to the reinsurer 1. Now the reinsurer 1 has got a retrocession support with the help of that business. So this is the chain. That is why this reinsurer 2 will be paying commission to the ceding insurer. That is called overriding. This is also a definition for ORC. So there are two definitions. Based on the context, you have to select what is the definition much apt for that scenario. This is another definition for ORC, overriding commission.
But sir, please
Yes,
go to the previous slide. Yes. Here, reinsurer 2 don't know, no, reinsurer 2 don't know who is ceding insurer, but still he will be paying a overriding commission to ceding insurer because reinsurer 2 got business from reinsurer 1. So there is no direct link between ceding insurer and reinsurer 2. Still, reinsurer 2 will give overriding commission to ceding insurer. Is it like that?
No, actually, what will happen is this overriding commission, in case of this inward retrocession, it will be happening on certain big risks, which are having names across the industries. For example, Reliance Petrochem. Reliance Petrochem is one major industry which will be having lakhs of crores of sum insured. And when this Reliance Petrochem gives business to a reinsurer 1, the reinsurer 1 will be accepting the session. He will be giving reinsurance protection and he will be paying reinsurance commission to the ceding insurer. Now, reinsurer 1 will feel that he is not having sufficient capability to meet out the claim of such a big entity. So what he will do is he go and enter into reinsurer into retrocession agreement with reinsurer 2. Now, this business is a named business. So reinsurer 1 will provide all the data where he procured this business, with whom he procured this business, what is the profitability of this business, what is the possibility of having a loss in this business. All these data will be communicated to the reinsurer 2. Based on these merits, the reinsurer 2 will be willing to either pay or not pay. It is purely his decision. So he might be feeling that this business is profitable. In that case, he will be okay to pay for the overriding commission. But if he feels that this business is having loss potential tremendously, he will be not paying overriding commission at all. So that's how it works.
Will he pay something to reinsurer 1 as well?
Reinsurer 1, yes, that is retrocession agreement, right? So in that case, retrocession agreement, based on that particular business potential, it will be decided whether there will be commission or not. These are when we are going to a retrocession level, all these things become case to case basis, because when a reinsurance company itself enters into a retrocession for a particular risk, the gravity of risk is very high. So everything will be decided based on case to case rather than on blanket terms. So it depends on the loss and depends on the risk's potential to earn profit. That is how
sir,
this
if
thing works.
reinsurer 2 gave some commission to reinsurer 1 also, what
Yes,
that
yes.
commission will be called?
That will be purely commission, that will be purely reinsurance commission. There is no certain terminologies for that. That is again a reinsurance commission, because basically retrocession is a reinsurance of reinsurance. So it is a reinsurance commission. Again, the terminology is same. Here, because of just for your ease of understanding, I have gone into this triangle concept. But originally what will happen is, the ceding insurer will give business to reinsurer 1. Reinsurer 1 will be paying back reinsurance commission. Now, reinsurer 1 will go and get coverage from reinsurer 2. Reinsurer 2 will be paying overriding commission to reinsurer 1, and it will be trickled down to ceding insurer. That is how it will work back. Because as you said, there is no direct relation with the reinsurer 2 and the ceding insurer. This transaction will occur through reinsurer 1.
Okay, now get it. Practically, it is happening.
Yes, ma'am. Yes. Okay. There are two other commissions. These are solely coming into picture for treaty reinsurance alone. Because in treaty, we are very much aware that multiple kind of risks, multiple number of risks will be seeded inside the treaty. There will be a scope given to the treaty. What are all the LOBs? What are all the limits of sum insured that can be entered inside the treaty? So all those scope of business will be falling inside the treaty. So what happens is reinsurers will be closely observing the treaty performance on every quarter. So based on that, at the end of the year, he might feel that a certain treaty has given him a very much profitable quantum, business quantum. In that case, he'll be willing to pay profit commission. Why he is willing to pay profit commission? Because he also wants to continue this relationship with the insurance company. He wants to get more business from that insurance company. He wants to establish even more ties with that particular country. So in that case, as an incentive for having such a good business relationship, he will be paying profit commission. This profit commission will be calculated based on the profitability of the treaty. So the profitability of the treaty will be worked out in this manner. The earned premium of the treaty will be first calculated. Then any claims given for that treaty, it will be deducted from the earned premium. Then any ceding commissions cancelled. I have left out the cancelled term, sorry. So any cancelled commissions, any cancelled premiums, those will be deducted. So after that, the net volume of the treaty will be weighed. If there is a profit, the profit will be assessed for a certain percentage, and it will be given as a commission to the original insurer. So that is how profit commission works. So this profit commission is there in existence because it is the primary objective of this profit commission is to continue the relationship with the insurer, continue getting good business, to also encourage the insurers to place good business. So that is why this profit commission is in existence. Then there is also one more commission which is over and above profit commission, that is super profit commission. So this is, as mentioned, it is given over and above profit commission. This is considered and this is given in extremely good business cases. For example, if a treaty has performed exceedingly well, there is very less loss ratio, say some 20 or 25% or 30%, that 30% of loss ratio for such a huge treaty. In that case, the reinsurer will be more than happy to continue this business, and he want to incentivize the insurer even more. In that case, he can go for super profit. He can be willing to pay for a super profit commission. So the super profit commission will be again calculated as a percentage on the total profit of the treaty. The calculations are same. It is just solely on the discretion of the reinsurer, whether he wants to pay super profit commission or not. So how he will decide? It is based on the treaty performance. If the treaty is very good, he will be willing to pay. If the treaty is okayish, he will be willing to pay only profit commission. If the treaty is bad, he will be not willing to paying any kind of these kind of commissions. The original reinsurance commission alone would have been paid, and everything will be done there itself. Reinsurance accounting, certain key regulations. So the preparation of accounts, the reinsurance transactions are done solely between two parties. One is insurance company and another is reinsurance company. But the data regarding the risk will be available only with the ceding insurer. So these data will be provided by the ceding insurer to the reinsurer. Hence, this preparation of accounts is possible only by the ceding insurer. So the preparation of account is the responsibility of the ceding insurer. The quarterly accounting system, as I mentioned earlier, quarterly accounting system is mostly preferred by the reinsurers because the reinsurers can get real life development statistics of the treaty. Every quarter, if the accounts are passed over to the reinsurer, he will be easily verifying whether the treaty is performing good or not. So he can take decisions based on that. Hence, always the reinsurers prefer quarterly accounting system. Then accounting year and underwriting year basis. There is an acronym URLA. I used to study with these kind of acronyms so that we won't get confused much. So I just thought like I can share it with you also. So I used to have this acronym URLA. So what this means is UR, it is a one single set, and LA is one single set. Underwriting year basis, risk attaching policies. Loss occurring basis policies, accounting year basis. So just remember this. I'll explain you what this acronym has a relation to. So there are two types of accounting. One is accounting year basis and another is underwriting year basis. So how this accounting works? In an accounting year basis, every transaction done in that particular financial year will be recorded in that year's accounting book itself. For example, financial year 2025-26, from April to March of 2026, April 2025 to March 2026. Any transaction done in this year, it will be written in the accounting book of that same year itself. That is accounting year basis. For underwriting year basis, for example, if there is let's consider the same financial year 2025 to 2026, there is a certain marine hull claim given in this particular year. For example, on the month of September 2025, we have settled a hull claim of marine hull claim of 100 crores. Now, for these kind of certain big
Kindly repeat,
value
sir.
claims,
Sir,
yes,
Kindly
sir, yes,
repeat,
yes,
sir.
yes,
yeah, the last
yes,
one,
yes,
what you have explained about accounting year basis, that is accounting
yes,
year
sir.
basis or underwriting year basis?
That is accounting year basis, sir. That is accounting year basis. In accounting year basis, every transaction will be accounted in the same running year. 2025 to 26, any transactions we have done, it will be accounted in the same running year. But a particular transaction is done in 2025, September itself. That transaction is for a payment of a hull claim. Say that transaction is worth of 100
Sir,
crores.
kindly repeat, sir.
Yes, sir. Yes, yes. I'll repeat. I'll just complete first and then I'll repeat. So this particular 100 crores of transaction, instead of accounting it in this current year's book, what I'll do is I'll find in which year this policy was originally underwritten. For example, this policy was underwritten on 2024 January. I'll find out the accounting book of that year and I'll account this transaction on that particular accounting book. If I do this kind of accounting, it is called underwriting year basis. Yes, yes.
Sir, can you be a little bit slower, sir?
Yes, sure. So I'll go slow. For accounting year basis, like I mentioned before, any transactions done on one particular year, that particular year's transactions will be contained in that year itself. For example, let's consider a policy issued on 2024 December. Now we are in 2025 December. This particular policy is having a claim, and we have paid the claim in 2025 December. Now this claim will be accounted in my current year itself. Financial year 2025-26 in itself, we will be accounting this claim. If we are accounting any claim for old policies in current year, it will be considered as accounting year basis. And if we are accounting this for on underwriting year basis, there is a different analogy. If I am accounting this particular claim on 2024 December's accounting book, that is called underwriting year basis. Are you able to catch up with, or should I go even slower, and should I go for even more examples?
No, perfectly, sir. Perfect.
Yes. Okay, fine. So that is how this thing is work. These accountings will work for any transactions that are done in particular one single year. If they are accounted in the same year's book, that will be considered on accounting year basis. But if a transaction is traced back to its original origin, if a particular transaction done this year, instead of accounting it this year, I am tracing it back in which year I have issued this policy, and then I am accounting it in that particular previous year. Then it is called underwriting year basis. I'm having a word problem for your numerical scenario for your better understanding. It is in the next slide. I'll explain you there also. So just for your information, fire and accident proportional insurance, they are always accounted on accounting year basis. Whereas marine and aviation proportional insurance, they are accounted on underwriting year basis. There is a reason why this is done in this method. That also I'll explain in the next slide. So loss occurring basis. Any claim reported in policy will be taken care by the current running treaty, irrespective of the period during which the policy was issued. So I'll first give you the example, then I'll walk you through the definition. So last year, one treaty was issued. That treaty was issued from 1 January 2024 to 31 December 2024. Now, in current year, we have issued one more treaty on 1 January 2025 to 31st of December 2025. One insurance policy was issued on 1 July 2024. So at the time of issuing the policy, the treaty that was live was last year's treaty. This particular policy will be running for 1 year. So this policy, even though if it is issued on 1 July 2024, it will be expiring on 30 June 2025. What happens is a claim occurred in this policy. This claim occurred on 1 February 2025. So under loss occurring basis, what I will do is I'll find which treaty is running currently. I'll pay the claim from that treaty. So the current running treaty will be 1 Jan 25 to 31 December 25. So if I am paying the claim from that treaty, it will be considered as loss occurring basis. Whereas if I am paying the claim by finding out during which this policy was issued, for example, 1 July 2024 is the policy issuing date. So on that date, what treaty was live? Last year's treaty was live. So if I am getting the claim recovery from the last year's treaty, it will be called as risk attachment basis, because we are finding on which date this risk attached, on which treaty this risk attached. We are going back to that treaty and we are asking for the claim from that treaty. That is why it is called risk attachment basis. And loss occurring basis, it is vice versa, because whenever a claim occurs, we are just finding which treaty is currently running. We are purely getting the claim from that treaty. Are you clear with this loss occurring basis and risk attachment basis?
Sir,
Anyone is
up to
having
the
any
last,
doubts?
sir,
Let me know.
sir, up to the
Yes,
last
sir.
Give it a
slide.
One by one, please.
Sorry, just for a simple means you have explained it very nicely. Just for a simple analogy, if you want to consider, or for just for an example, actually it is like the retroactive date.
Yes,
It's
ma'am.
claims
Yes, yes, yes.
occurrence basis and claims and occurrence basis in regard with retroactive date. It is the same actually. Means if someone wants to understand this concept, claims occurrence basis and the example can be considered in for a retroactive date also.
Yes,
The
ma'am.
way
That is a
we
great
settle the
analogy.
claims in respect to retroactive date, the concept of retroactive date actually.
Yes, 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 ma'am. Actually, it is a very good example to take in a retroactive date. It will give some
excuse me,
better
sir.
clarity. Yes, sir. Yes, 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 sir.
Up to the last slide, it was totally understood. In this slide, can you repeat it again?
Yes, yes. I'll
Sir,
repeat it again, sir. I just went through the numericals. I'll repeat it again slowly. So
sir,
what
one more
happens is
request. Can you please
yes,
attach this example with that accounting year basis and underwriting year basis?
yes, sir. That also I'll do. Once, for the sake of easier understanding, I'll just finish off this loss occurring basis and risk attachment basis. And in the
Yes,
same
yes,
example, I'll pull in the underwriting year basis and accounting year basis. So I'll
yes, sir.
walk
Yes,
you through slowly. Every year, these treaties, in general, the treaty is a yearly agreement. So every year we will be renewing these treaties. What happens is, so for the year of 2024, we have entered into a treaty. Let's consider that the treaty is named as A. So treaty A ran between 1 January 2024 and 31 December 2024. Now, this year, on 1 January 2025, I renewed treaty, but I renewed it with another reinsurer. So this treaty, you can name it as Treaty B. So my Treaty B has the duration from 1 January 2025 to 31 December 2025. So what happens is, I have issued a policy originally on 1 July 2024. So at the time of issuing the policy, the treaty that was live was Treaty A. I hope you are following with me. So when a policy was issued on 1 July 2024, the treaty which was live at that time was Treaty A. But this policy has received a claim. This claim occurred on 1 February 2025. So the claim occurred when the Treaty B was in existence. On 1 February 2025, Treaty A is not of relevance because Treaty A expired on 31 December 2024 itself. Whereas this claim happened on 1 February 2025 and Treaty B is live in that. So this claim is amounting to, for example, if that claim is amounting to 10 crores and we have to get a reinsurance recovery of 5 crores from the treaty. So 5 crores, if I am going and getting it from the Treaty B, because that treaty is the one that is live at the time of the accident, I am going and getting the recovery from Treaty B. It will be considered as loss occurring basis. Whereas if I am finding during which treaty period this policy was originally underwritten, I'll go back and I'll take the claim recovery from that particular treaty. This policy was issued on 1 July 2024. At that time, Treaty A was actually in existence. So I'll go back and I'll get the recovery from Treaty A. If I get the recovery from Treaty A, it is called as risk attachment basis, which means I am finding the treaty during which this risk got attached, and I am finding that treaty and I am getting the recovery from that treaty. That is why it is called as risk attachment basis. Whereas loss occurrence basis is a continuous theme. At the time of occurrence of loss, we are just finding out which treaty is in current existence. We are getting the recovery from that treaty. So I believe loss occurring basis and risk attachment basis is now clear. If it is clear, I can move on to accounting year basis and underwriting year basis.
Very clear.
yes, sir.
Okay.
Yes, sir.
I'll move on to accounting year basis
Very
and
clear, sir.
underwriting year basis. Okay, sir. Okay. Thank you. Thank you. So accounting year and underwriting year basis. Now we have approached this problem on the basis of claim settlement. Now we have to move on the basis of accounting this transaction. So what I do is, now I'm coming out of this claim settlement, I'm entering into the accountant role. Now I have an accounting book for every year. For 1 January 2020, for a clearance sake, I'm taking the financial year as January to December itself, for clarity sake. For 1 January 2024 to 31 December 2024, I will be having one accounting book for that particular year. Then I would have closed the accounts on the end of 31 December. I would have kept the book there. Then on 1 January 2025, I would have started a fresh accounting book, and it will be running till the end of 31 December 2025. So what happens is, one loss occurs, and that loss occurs on 1 February 2025. So at that time, what is the accounting book I am having? I am having the accounting book pertaining to 2025. If I am recording the loss amount on that particular accounting book, it will be it will be considered as accounting year basis, because I am just having a accounting book which is open at that particular loss time. I am purely recording the loss in that particular accounting book. It will be called as accounting year basis. So accounting year basis, how it will work is, we will be finding out a loss transaction. That transaction we will be recording in the book which is active at the time of that particular year. I believe I'm getting you into somewhat clarified nature. So I'll repeat it once again. If there is a claim transaction occurred on 1 February 2025, if I am recording that transaction in 2025 accounting book, it will be called as accounting year basis. Whereas if this particular transaction, instead of recording in the 2025 book, I am finding under which policy this transaction occurred. So I'm tracing it back that this transaction occurred for a policy that was issued on the year of 2024. So what I'm going to do is, I am going to account this particular transaction on 2024's accounting book. If I do it in this manner, it will be considered as underwriting year basis, because the year in which I underwrote this policy, I'll account all the entry pertaining to the policy on that particular year. That is my standing. If it is my standing, it will be considered as underwriting year basis. I believe now it is somewhat clear for everyone.
Crystal clear, sir.
Very
Okay.
clear.
I'll put an example also why we are doing this, because when it is considered for we studied these 2 points where fire and accidental proportional insurance will be on accounting year basis, marine and aviation proportional insurance will be on underwriting year basis. Why this is so? Because a property claim, say fire or accident claim, when compared to a marine or aviation claim, it's very small. It might be large, but it is a outlier. In common, it is a smaller claim. Property lines will be having a smaller claim compared to a marine hull claim or a aviation hull claim. So what happens is, if there is a claim outgo of say 100 crores in property lines for a particular year, it is easy for me to account it in my same year, because I will be having, let's consider the example of New India itself. We are making some 50,000 crores per year as a transaction. So 100 crores is not such a huge amount to skew our accounting book. So what we can do is, we can comfortably account that premium inside our current accounting book. Whereas we have issued a marine hull policy on 2024, and that marine hull costs 2,500 crores. And what happened is, this 2,500 crore worth of marine hull entered into a total loss on 2025. I have paid the loss in 2025. 2,500 crores has become an outgo in my book. Now, if I am accounting that 2,500 crores outgo in my current year's book, it is going to affect my current year's performance badly. Whereas original transaction occurred on 2025 or 24 only. So what I'll do is, I'll take this 2,500 crore and I'll account it in 2024's book, because I underwrote the policy on 2024. So I want to give the loss credit to 2024 only. I don't want to take the ICR to the current year. That's why I prefer putting this marine and aviation huge claims to the underwriting year itself. That is why this came into existence, where the marine and the aviation lines were always accounted on underwriting year basis, because the loss will be very high. If we put the loss in current year's book, it will skew our results badly. That's why the loss will be actually taken back to the original year when the policy was underwritten, and it will be tagged there. That's why this kind of practices are there. I hope now you are clear with the reason why the marine and aviation LOBs are with underwriting year basis.
Yes, sir.
Sir, can it be related with the proportional and non-proportional treaties?
Can it be related with proportional and non? Can you please put more clarity in your question, ma'am? What you are willing to know about?
Sir, just like in underwriting year policies that we are considering only for proportional treaties only. Only proportional treaty losses are or policies are being basis on the underwriting year basis.
Okay, for your example, I might have missed out this underwriting year basis, accounting year basis, all these things will always be linked with proportional. Non-proportional methods will always be on loss occurring basis, because non-proportional insurance in effect is a basic insurance transaction. What happens is there is no how to say. Okay. In non-proportional reinsurance, the relation between the insurer and reinsurer is very different. We'll be using one term, reinsured. Reinsured will be the term used only in non-proportional reinsurance, because it is a very simpler cover. There is one fixed deductible, and whenever the deductible exceeds, the claim will be paid. That's it. There is no need for a proportional share. There is no need for contribution from the insurer and the reinsurer for various proportional parts. That kind of requirements are not there in non-proportional reinsurance. Yeah, non-proportional reinsurance is like a guarantee policy, which will operate at the beginning of the contract. It will be there working like a top-up policy. Whenever the loss exceeds that trigger, it will act like a top-up policy, and it will pay for that loss, and then it will go back. So that is how it operates. That's why these kind of loss occurring basis, risk attachment basis kind of concepts are not much relevant to non-proportional treaties. Non-proportional treaties operate very simply. They are always occurring. They are always operated on the basis loss occurring basis. There is no other methods as far as non-proportional treaties are concerned.
Also, they
Moreover,
are for
Yes.
day-to-day claims, means minor claims, the accumulation that has been done. So, non-proportional are majorly for those kind of claims, right, sir?
Yes, ma'am. Excellent analogy. Excellent analogy. They are mostly linked with the day-to-day accumulations. So these day-to-day accumulations are not that huge in order to make it to work under the underwriting year basis. They can easily, comfortably accommodate it inside the current running year itself. That is also one analogy why we are using only loss occurring basis for non-proportional insurances.
In loss occurring basis, it will be easier for portfolio withdrawal and entry in comparison to
Yes,
underwriting
sir.
year
Yes,
basis.
yes, yes. It is very much easier. It is very much easier. Yes, yes, yes. Okay.
Sir,
Sir,
about the
in
liability.
the writing year basis, how long the books will be open?
Sir, it purely depends on what kind of business constitutes that book. For example, if a huge marine hull claim occurs, and the claim takes 3 or 4 years to be settled finally. So, for this huge quantum of a claim, it is a necessity that that particular underwriting year book has to be kept open. Even though it might be a discomfort for the insurer, it is much better if he keeps it open and accounts the loss on that particular book, because if he is closing that particular underwriting year book, and after 5 years the loss has become finally ripe to be paid, and if he is paying it out of the current accounting year without getting any major claim itself, he will be facing a huge out, which will be recorded as a big negative impact in his accounting book. So underwriting years book, they will be mostly kept open as long as possible, only in case
Yes,
of
it will be.
extreme difficulties.
And
Sir, it will be
Abhi,
10, 20
excuse
years?
me, dear participant, let him go one by one. Don't jump. He is clearly explaining everything.
Sir, it will be 10,
Let
20 years?
let him do his, on his own. Don't
Sure,
jump.
sir. Thank you. Thank you. Thank you. I'll explain, sir. I'll explain.
Okay.
So it can be kept open for say 5 years or 8 years or 10 years.
Okay.
When an insurance or reinsurance company considers that particular claim has lost its relevance after sometimes after so much number of years, like you said, a company might find it comfortable to keep the book open for 10 years. But after 10 years, if it is still, the claim is still long pending without getting settled, the insurer can think that he has already transacted for 10 years. He would have earned profit for those 10 years. So he will be able to undertake that, absorb that risk in the current accounting book. In that case,
Okay.
he'll close that particular underwriting book, and he'll be ready and he'll be prepared to accommodate this risk in his current book. That will be the situation when the duration exceeds long, because the insurance company is running for profit. For 10 years or 20 years, he would have made at least a minimum number of profit to accommodate this risk in his account. There is also alternative scenario. A company might not always be going in an upward trajectory. Yet after 10 years, if a particular company is in even poorer position, what he will think is, if I am going to close that particular underwriting book, I will be having to bear one more huge loss in my current year. So I'll better put it open even if it is taking 15 years. That might also be an analogy of a company. So it purely depends on that particular company and the reinsurance companies stand in that kind of claim. There is no hard and fast rule how much year their book has to be kept open. It is purely based on the company's risk appetite. It is purely based on the reinsurance company and insurance company's decisions. So there is no
Sir, will it,
hard rules. Yes, sir. Yes.
will it not hit IBNR?
Thank you,
What,
sir.
sir?
Sir, how the effect of IBNR for these claims, sir? Underwriting
No,
year
sir.
transaction.
IBNR is incurred but not reported. But we are talking about incurred and reported but not yet settled. Only these claims are of importance in these cases. IBNR is completely different as far as these concepts are concerned. We are talking about purely incurred and reported claims. We also know the quantum, but we are yet to get the settlement done because there might be documentary issues, there might be geopolitical issues, or there might be issues in terms of finalizing the last quantum. These kind of issues might be delaying a loss payment. We have already arrived at the loss. It is just taking time for the payment. In these kind of situations, we are opening the book. IBNR is different because IBNR incurred, the client would have incurred. We would have not got any intimation. So we have to create a provision. That is completely different for when compared to this.
Okay, sir. Thank you.
Okay, sir.
Liability
I will
claims
move on
are
to
on
next topic.
underwriting year basis. Sir,
What,
was
sir?
last question. Liability claims are on underwriting year basis.
Sir, again, this liability claims based on their quantum, it will be tagged to the particular method. If the liability claim is for a product liability of a medicine company, and there is a probability of huge claim outgo if there is a court award, they'll probably put it under the underwriting year basis. Whereas if the liability claim is for a product liability company of an automobile component manufacturer who is manufacturing a small cosmetic part, it is not going to be a critical function of the automobile, but it is a cosmetic part which is having a minor defect. In that case, this will be a smaller liability. So he will be willing to put it inside the accounting year basis instead of unnecessarily opening up the underwriting year basis. So all these things are current running decisions. These are all will be decided based on the quantum, based on the loss potential of the business. So
Sir, one more
what we have to
question.
be clear is, yes, sir, yes.
Sir, it is at the discretion of the reinsurer in I
It is at the
loss book
discretion
either
of the insurer and the reinsurer. Both have to
Acha.
decide.
Either
Okay,
to
sir.
go for underwriting or accounting there.
Yes, sir. Yes.
Acha.
Okay. Okay, sir. I'll move on because it has taken much in this topic itself. I'll move on. I have to cover certain other topics also. I'll move on now.
Yes, sir, please, sir.
I'll move on to ground-up loss. So this is an important terminology as far as excess of loss insurance is concerned. So the definition goes like that: the entire amount of insurance loss, including deductibles, but net of salvage and recoveries, is known as ground-up loss. I'll put you a numerical example which will give you a clearer picture. If 100 lakhs loss occurs, the insurance company's retention is 40 lakhs. There is a deductible in this policy of 10 lakhs. And the reinsurance is done via an excess of loss reinsurer. And the excess of loss layer is like this: 50 lakhs in excess of 40 lakhs. Now, in this claim, there is a salvage recovery of 5 lakhs. So we have to find the ground up loss. Now we'll go step by step. The actual loss occurred is 100 lakhs. Recovery available via salvage. In this case, we should only look after the recovery available via salvage or any other means. We should not look after the recoveries available via reinsurance. That is not under the scope of ground up loss. We have to only consider the salvage or related recoveries. So recovery available via salvage is 5 lakhs. Now, in that 100, we deduct 5 lakhs salvage. Remaining loss is 95 lakhs. So for calculating the ground up loss, we have to deduct any available salvage and any other recoveries other than reinsurance recoveries. So this 95 lakhs will be considered as ground up loss. So any loss when it occurs, we will be taking the ground up total volume. On that total volume, we will be reducing any recoveries or salvage available. The net result will be considered as ground up loss. This is ground up loss. In this case, 95 lakhs is the ground up loss. Now, some pointers. For calculating this ground up loss, we should not deduct retention or deductible amount, because we have mentioned there is a retention of 40 lakhs in this policy. This retention and all should not be deducted. Again, the same, there is a deductible of 10 lakhs. It should not be deducted. Retention, deductible should all be constituted inside the ground up loss. We should not deduct those portions. Similarly, recoveries here mean any recoveries other than reinsurance recoveries. Salvage recoveries might be given, any other kind of recoveries that reduce your loss, that might be considered. But reinsurance recovery should not be taken into picture as far as ground up loss is concerned. Now, after calculating this ground up loss, we can calculate the net loss for the company. So here, the net loss for the company, how much? 95 lakhs is the ground up loss. On that, we will be deducting the deductibles, because excess the company is not going to pay. Excess the insured is going to pay. So 10 lakhs is the excess here. So in that 95 lakhs, we will be reducing 10 lakhs. So out of that, we are getting only 85 lakhs. This 85 lakhs is totally payable. This will be considered as net loss, purely net loss. Now the XOL reinsurer comes into picture. After arriving at this net loss, the insurance company will go to the XOL reinsurer. He will say, I have got a loss of 100 lakhs. Out of this 100 lakhs, I have got a recovery of 5 lakhs. So my ground up loss became 95 lakhs. And on my ground up loss, there is a deductible in the policy, which will be borne by the insured itself. So I have reduced the deductible also. Out of that, 85 lakhs is the total net loss. Now, in this net loss, as per the XOL conditions I have entered with you, there is a 40 lakhs retention by me, deductible by me. So in this 85 lakhs, I'll retain the 40 lakhs, you pay the balance. This is how the insurer will approach to the XOL. So the XOL reinsurer will pay 45 lakhs. That is, on that 85 lakhs, 40 lakhs will be retained and the remaining 45 lakhs will be paid by the XOL reinsurer. So this clearly gives the definition for ultimate net loss. This 45 lakhs will be considered as the ultimate net loss for this particular XOL layer. So you have to get the differentiation between these two losses. One is ground up loss, one is ultimate net loss. In between these two, there is one more loss called net loss, just pure net loss. So here ground up loss means any loss that is constituted after deducting the recoveries. Then we have to arrive at the net loss. Net loss can be identified. Yes, sir. Yes.
Hello.
Net loss can be identified. Yes, sir. Yes. If you want to ask anything, you can ask.
Sir, this ultimate net loss is for reinsurer or insurer?
No, this ultimate net loss is in the point of view of the excess of loss reinsurer, it is the claim payable under his excess of loss coverage. In the point of view of the insurer, it is the recovery available under the excess of loss coverage. Ultimate net loss is same. Based on the point of view, the analogy differs. If the reinsurer looks on the ultimate net loss, he thinks as that is the maximum liability he has to give. If the insurance company looks at the ultimate net loss, he'll think that this is the maximum recovery I can get from the insurer. So that is the analogy.
Sir, sorry to interrupt you.
Yes, sir.
Sir, if there are quota share or surplus treaty in between, so
Yes,
whether there will be any changes in the ultimate net loss or gross loss? Ground up loss?
Definitely, ma'am. Definitely. Ground up loss will not be disturbed with the proportional arrangements. Whereas in calculating ultimate net loss, if there is a recovery available under a proportional policy, that also has to be deducted. In this example, what we have done is we have deducted 40 lakhs retention. For example, if there is a 10 lakh recovery available in a proportional treaty, we have to deduct that also. In that case, the ultimate net loss will become 35 lakhs. So for calculating ultimate net loss, we have to reduce all the recoveries from other reinsurance arrangements also. It is a very
For
good
the
question.
ground up
Thank you
loss, there
for
will be no
putting this
changes.
question. No, there will be no changes in ground up loss. Ground up loss is hard and fast fixed loss. But ultimate net loss varies based on the recoveries available.
Okay, thank you,
So
sir.
won't the recoveries from other reinsurers get factored in the deductible of the XOL treaty?
Yes, sir. That's why ma'am has asked that, and that is what I have also clarified. If there is any recoveries available from other proportional reinsurance treaty, what we will do is we will deduct, for example, in this case, net loss is 85 lakhs. There is a retention of 40 lakhs. So after that retention, remaining loss is 45 lakhs. For example, if there is a proportional treaty which is paying you 15 lakhs, then we will recover that also. In that 45, we will deduct the 15 and balance 30 crores will be the 30 lakhs will be the ultimate net loss. So for ultimate net loss calculation, we have to deduct all the other reinsurance recoveries that is available before this particular excess of layer comes into picture.
Sir, and what about the subrogation and the contribution recovery, which affect the ground up loss?
Yes, ma'am. In case of no, for ground up loss, the subrogation or contribution, whatever, it will always occur after the settlement has been done. Subrogation will occur only after the payment has been done. So, for at the time of identifying the ground-up loss, subrogation will not be coming into the picture. But once all these adjustments have been done and recoveries have been completed, when the original insurer goes for subrogation and he recovers any amounts by means of subrogation, that will be properly contributed between the reinsurance companies who and all have contributed for that particular loss. They all are entitled to receive the subrogation proceeds from the insurance company. It doesn't comes into picture as far as the ground-up loss or ultimate net loss is concerned, because this ultimate net loss, ground-up loss are all the terminologies that are associated before the settlement of losses. Subrogation arises after the settlement of loss and after getting the title for that particular recovery rights. So subrogation doesn't comes into picture as far as ultimate net loss or ground-up loss is concerned. It should be kept later on. Only the portions before the settlement of loss has to be considered.
Okay, so can we
Thank you,
say that
sir.
can
Thank
we
you,
say
sir.
that considering your example of 10 lakh recoveries from the proportional treaty,
Yes, sir.
so 10 lakh rupees is the ultimate net loss for that proportional treaty. That is okay?
Yes, yes, very much, sir. It is ultimate net loss for that proportional insured. Yes.
Okay, so as I
So
understand
ultimate
that,
net loss is purely dependent on that particular layer of the reinsurance company. So in this scenario, for this excess of loss reinsurer, his ultimate net loss is 45 lakhs. If there
okay,
is
so
one more excess of loss insurer who is having, for example, 10 lakhs protection and he has to pay 10 lakhs, his ultimate net loss will be considered as 10 lakhs. So it
okay,
depends on the layer of the reinsurance.
so consider, I'm just summing it up. Gross ground up loss is for the insured, how much he will get claim. Ground up
Yeah, yes, you
for
can
the
also put
insured,
it as
and
that kind of analogy. Yes, yes,
differently
yes.
for ultimate net loss is for from that particular treaty, how much insurance company will get from that particular treaty.
Each reinsurer, how much the insurance company will get from each reinsurance company, reinsurers.
Correct. Thank you.
Yes. Okay. Let's move on. Okay. I'll be going to the insolvency situations. I hope many will be familiar. Still, I'd like to inform how the insolvency situations work in reinsurance. So, if the ceding insurer becomes insolvent, the reinsurer has to pay his share of claim in spite of the ceding insurer becoming insolvent, because this there is one clause called follow the fortunes clause, but this follow the fortunes clause applies only for insurance fate and not for commercial fate. We would have come across these terms: insurance fate, commercial fate. So if a ceding insurance company is becoming insolvent, it is his commercial fate, it is not his insurance fate. Even though if he is becoming insolvent, if he is liable to pay to an insured a sum of say 10 lakhs, and out of the 10 lakhs, there is a 6 lakhs reinsurance recovery to be paid by the reinsurer. The reinsurer cannot step out and say that the ceding insurer has become insolvent, I will not be paying any share. He has to still pay his policy obligations, even though there is no ceding insurer available in active form. So, insolvency of ceding insurer will not affect the liability to be settled for the reinsurer. He has to pay his own share of claim, even though the ceding insurer becomes insolvent. So this is called the sharing of insurance fate rather than commercial fate. Okay. Reinsurer insolvency situations, insolvency of reinsurer. So now we are going to the vice versa situation. A ceding insurer has gone and found a reinsurer who is giving very attractive rates for a reinsurance agreement. Now, the ceding insurer, after analyzing all these companies, he locks his reinsurance agreement with this company, say company A, who has given the lowest reinsurance premium. Now, he is transacting the reinsurance business with that company. In the middle of the year, what happens is this particular reinsurer A, he has become bankrupt because of his poor underwriting practices and poor risk rating factors. He has become bankrupt. Now, the ceding insurer cannot say that the reinsurer has become bankrupt, I can't be able to pay his share of the reinsurer to my policyholder. He has to pay his share of claim, because selection of reinsurer is solely the responsibility of the ceding insurer. He should have done his due diligence. He should have referred the credit rating of the company, sovereign rating of the country. After that, he should have selected a reinsurer. If he has made any mistake, the policyholder should not be penalized. So, even though the reinsurer becomes bankrupt, ceding insurer will be fully liable to pay his share of claim and also the reinsurer share of claim. Okay. I will enter into retentions. So there are retentions is a core concept as far as reinsurance is concerned, because whatever the reinsurance agreement we enter into, the ceding insurer or the reinsured has to bear a retention. Only after that he can ask for a reinsurance protection. So these retentions can be categorized into two types: per event retention and per risk retention. This is more apt definition for excess of loss reinsurance. This is not in relevance to the proportional reinsurance. So as far as excess of loss reinsurance is concerned, per event retention is managed through reasonable estimation of financial consequences. So what is this per event retention? It is, at simple term, a retention at the time of a catastrophe. So an event is a catastrophe. When a catastrophe occurs, the insurance company has to analyze what amount of quantum he can retain, so that only after analyzing this quantum he can go for suitable excess of loss cover. So how he can analyze this? He can analyze this through reasonable estimation of financial consequences by allowing a catastrophe fund to accumulate and be available over the long term. So for example, if a insurance company likes to purchase a catastrophe reinsurance cover, and he is approaching a reinsurer, and he is asking for a catastrophe cover for 200 crores in excess of 100 crores. Now, in this analogy, 200 crores is the cover given by the reinsurance company. 100 crores will be the retention by the reinsured. So for this 100 crores, he would have some amount of means to pay this 100 crores worth of retention. So how he can do this calculation of how I can manage 100 crores? So he can do this by two methods. One is he can do a reasonable estimation by zone-wise accumulations. He can categorize the zone like north, east, west, and south zones, and he can do accumulation study, and he can come into conclusion that for a maximum earthquake magnitude, I can have at the maximum this much of quantum. Or he can do other thing. He can just create a catastrophe reserve fund. So every year he can put an amount inside the catastrophe reserve fund, and whatever the fund is available, he can consider it as a retention. And over and above that fund, he can go for reinsurance protection. So per event retention can be managed through reasonable estimation of financial consequences and by allowing a catastrophe reserve fund for accumulating and be available over long term. And next is the per risk retention. So per risk retention is very simple. It is purely the retention that a company wishes to do on one individual risk. For example, there will be two plants sitting nearby. One is a petrochemical plant, one is a sugar manufacturing plant. The insurance company might feel that the retention on this particular petrochemical risk should be kept lower, because the probability of hitting that loss quantum is very easy. So he might want to reduce his retention levels. Whereas in a sugar factory, he might find that compared to a petrochemical factory, it is having a better prospect of escaping without a loss. So he can increase his retention in this particular risk. So that is how per risk retention is done. So this per risk retention can be managed through controlled and informed decisions. So who will decide? The company will decide. So what he will decide? How much quantum he can retain on one particular risk. So that is why I have included these two things. You can I have seen that these questions have been asked in multiple exams with these exact linings. That's why I wanted to put this in question. Put this into this slide. The per event retention is managed through reasonable estimation of financial consequences, whereas per risk retention can be managed through controlled and informed decisions. Okay, PML based operations. So when reinsurance transactions are done, we have seen that most of these reinsurance transactions will be done on PML basis. Why so? Because on a risk, say of some insured 100 crores, there is a probability that even though if it is completing as if it is suffering a major fire event, there might not be a possibility of having more than 70 crores loss. So in that case, why should I waste my reinsurance purchase for 100 crores? Because the maximum probability of the loss itself is 70 crores. If I am going for PML method, I can purchase reinsurance covers effectively. So that's why we have completely shifted to PML based operations. Now this PML, probable maximum loss, it is an estimation. So only the insurance company, based on the underwriting data he has, or based on the risk engineers available with him, he can estimate what is the probable maximum loss of a particular occupancy. And based on that, he can go for reinsurance protection. It helps him to get reinsurance cover in efficient manner, because instead of wasting reinsurance coverage by purchasing unnecessarily high limit, he can plan for suitable limit by PML method, and he can buy the covers adequately. That's why PML based operations are preferred. So there is analogy. On a better risk, PML will be small, because if the risk is a better risk, it will be having good qualities. So the probability of maximum loss will be lower. In that case, what the company will do is it will go for a higher retention. On the converse, if there is a poor risk, there will be a high loss probability. So PML will be high. what the company will do is it will try to reduce its retention. This is the analogy. Then one more thing, there is one terminology called loss limit. It is particularly used in mega risks, where in the earlier example I pulled about Reliance Petrochemical or Adani Power, where one particular occupancy itself has sum insured in terms of lakhs of crores. In that case, what happens is in India, we are the largest general insurer. So New India Assurance will be having a certain capacity. New India Assurance will be willing to take risks for about say some 5,000 crores or 10,000 crores. And New India will be thinking that if there is a risk that is having sum insured more than 10,000 crores, I can comfortably go up to 50,000 crores with the help of the support of reinsurance. And we will be having one more issue also. For risk having sum insured of 2 lakh crore, New India will be thinking that up to 50,000 crore, I can go with reinsurance supports. Then we have to hunt for further reinsurance. And when we are going for hunting other reinsurance coverages, we are finding that the market itself is scarce. There is no one available to give that kind of protection. In that case, what the company will do is they'll approach the original insured and they'll inform that this kind of sum insured coverage is not available anywhere, even with the support of the reinsurer. So what you do, you at least inform what is the loss limit you wish to have. So this loss limit, on the contrary, where PML was estimation done by the insurer, this loss limit is a limit selected solely by the insured, original insured. So what the company will say is, it will ask the insured, you set a limit for yourself. On that limit, we will work, because after that limit, there is no availability world over. So instead of going for this full capacity, which is not available, you set a limit. What is the maximum limit that can be comfortably comfortably tackled by you with the support of the insurance. So the insured will select a certain capping. For example, in the example I said previously, let's consider there will be a sum insured of 2 lakh crores for one Reliance Petroleum plant. The insurance company will be advising him, instead of taking 2 lakh crores of sum insured, because this one petrochemical plant will be sprawled across acres. So you can think yourself how much of loss can occur in times of adverse scenarios. So New India might ask the insured to select a loss limit which is possible to work with and which is possible to obtain reinsurance coverage from. In that case, the insured might feel that he will be comfortable with 50,000 crore worth of cover. He will be very much aware that after that 50,000 crore, there is no protection available. But at least up to this 50,000 crores, there is a possibility for recovery from insurance company. So that is how this concept works. It is purely for mega risks. Loss limit is a limit that is selected by the original insurers. It is done only in mega risk occupancies, where RI support will not be sufficient for covering the entire sum insured of that risk. In that cases, we go for loss limit. Then catastrophic cover ratings. This I have explained earlier. Payback method. Payback method was earlier used. Recoupment of catastrophe loss through premium collected over a period of 250 years. This 250 years was a common analogy kept earlier.
Hello, sir.
Yes,
Can you
yes,
explain this PML burst?
PML burst. Yes, ma'am. So we have mentioned that this PML is an estimation done by the insurer. So this insurer can sometimes go wrong in certain chemical insurance plans. He might have thought that this chemical would be having this much of flammability, and on that basis he would have arrived at a PML. But what would have happened is, genuinely at the time of loss, this PML would have been completely felt unsuitable. For example, in case of 100 crores risk, the insurance company would have thought like 50 crores is the PML possible. But when the risk occurred, what happened is there is a loss of 70 or 80 crores. In that case, what the scenario we will call it as PML burst, because the original PML, probable maximum loss estimated by the insurer, has gone wrong, and the actual risk occurred has exceeded the PML. This is called PML burst. There is a PML burst clause which I have dealt with the reinsurance clauses in the later section of this PPT. I'll explain you clearly what and how this PML burst will be handled by.
Sir, PML is for a specific business, like for quota share, for excess of loss, or for any.
No, PML is for across the business. PML is not restricted to one particular class of reinsurance. It is for across the classes of the reinsurance.
Okay.
Okay. So this payback method I have already informed. I have already mentioned how this works. Cash loss recovery facility. Cash loss recovery facility is an option available under a treaty. So if there is a reinsurance treaty and the treaty is having 100 or 200 crores worth of coverage, at the time of the inception of the treaty itself, this cash loss recovery facility limit will be set by the insurer and the reinsurer. They both in concurrence, they'll arrive at a point and they'll set it as a cash loss recovery facility. And when a claim hits that particular quantum, the insurance company will go and ask for cash loss recovery quantum from the reinsurer. The reinsurer, even before the adjustment of the final claim, he'll pay in advance this cash loss recovery quantum. And after at the time of final adjustment, we'll deduct any losses paid earlier. That is how cash loss recovery facility works. Gross to net evaluations. So in terms of reinsurance, it becomes two accounts. Two accounts in the sense the original insurance company will be having two accounts. One is net retained account, another is gross direct account. So net retained account is nothing but after placing all the reinsurance arrangements, what is the actual retention held by the original insurer? That particular retention account is called a net retained account. Whereas gross direct account is called the total account. That includes the reinsurance placements, that includes the retention accounts, everything combined is called gross direct account. For example, if there is a company having 1,000 crores worth of business and he has planned that 200 crores will be the retention possible by him, and remaining 800 crores worth of business he has completely reinsured. In this case, the net retained account will be 200 crores worth of business. The gross direct account will be 1,000 crores worth of business. This is the difference. So this net retained account, it is expected to sustain its losses over a period of time. So why this is explained like so? Because the insurance company is selecting the retention amount. It is the insurance company who is selecting the retention point. So how he will select a point? He will select a retention point on the basis that up to this retention level, there will be not much adverse claims. The results will be somewhat smoother. So I can bear. So that is how this net retained account is expected to sustain its loss ratio over a period of time. Yes, sir. Okay, I'll continue. So this net retained account is expected to sustain its loss ratio over a period of time. It doesn't need any RI support. With the over the period of time itself, it can slowly sustain itself for its loss ratio. Whereas this gross direct account, it is expected to be subjected to as wide variation as the exposures permit, because this gross direct account includes two things. One is net retained account, another is the quantums we have placed for the reinsurers. So this for which agreements we will go to the reinsurers, any quantum that is not possibly payable by us, we approach for reinsurer support. So this gross direct account is comprising that account. So the claims ratio will be very wide. That's why it will be swinging very widely as much as the exposures permit. That is why these definitions are constructed so.
This gross direct is equal to the sum insured of that risk. The sum insured of risk is the gross direct account.
You can take it as an analogy. For example, if a sum insured of the risk is 100 crores, 20 crores is retained by you means that 20 crores is the net retained account. The entire 100 crores will be considered as gross direct account. Okay, I'll enter into the clauses. I'll swiftly go through the clauses because I believe so. Clauses would have been even there. I think there is a earlier one reinsurance clause taken in the last week. So in that class also I found that clauses were taken. I'll just brush you through what is what. I'll let you know what is the concept of a clause so that it can be useful for you to omit the other answers in your exam. So operative clause, reinsuring the original risk.
Hello.
This clause, operative clause, describes without any ambiguity the business coming
साढ़े
within
सात से
scope
क्लास
of the
अटेंड
reinsurance
कर
company.
रही हूँ रीइंश्योरेंस की बताओ बेमतलब में वहां धक्के खाने गई थी इंश्योरेंस
Ma'am,
इंस्टीट्यूट
please
की सही है
mute your mic, ma'am. Please mute your mic, please. Okay, so operative clause. It describes without any ambiguity what is the scope of the business that comes into the treaty. So it is like a definitive clause. The operative clause defines what are the businesses that are coming under the scope of the contract. So once the operative clause has been put, the insurer has to cede whatever the business that comes under the scope of the treaty, as well as the reinsurer has to accept all the risks that come under the scope of the treaty. So the business covered will be stated in this clause. Territorial scope will be stated, like business from US and Canada will be excluded, like that, and all these territorial scopes will be mentioned. Maximum liability under the treaty will also be clearly mentioned. This liability will be mentioned in terms of either lines in case of surplus or in terms of percentage in case of quota share. Then commencement and termination. So for a treaty, the treaties will have a commencement time and termination time. So this commencement and termination clause will mention what is the beginning of the treaty and what is the end of the treaty. So most of the times, the inception will be a date agreed between the insurer and the reinsurer. Mostly it will be based on the time zone of the insurance company, not the reinsurance company. It will be based on the insurance company's time zones. So this commencement and termination will also mention under what cases a treaty will be terminated. So there are certain situations when the treaty will be immediately terminated. For example, there is a relationship between India and UK. In India, one insurance company has got a reinsurance coverage from a company who is based on United Kingdom. So now there is two countries in contact. One is India and one is UK. When a law is passed between either of these countries, either India or UK, and that particular law has brought some kind of prohibitions between transactions between these countries. If such a scenario happens, what will happen is the reinsurance treaty will immediately terminate. If there is any law passed by the country, then it will that prohibits the transaction between these countries, then the reinsurance will terminate. Again, if any other party has become insolvent or unable to pay its debts, then the treaty will become insolvent. In this case, the treaty will become terminated, but any liability due to the reinsurer until this point, the reinsurer is liable for his share. He will not go back from that liability. If there is a material change in the ownership or the control of the other party. So if the reinsurance company or the insurance company, the ownership shifts suddenly in the middle of the treaty will be terminated. If any contract parties country is involved in armed hostilities or any with any other country, whether there will be war declared or not, we will be considered as a warlike scenario. We will be terminating the treaty. Okay. So notice of termination. So there will be certain procedures adopted in notice of termination. This notice will be always considered to be deemed to be dispatched when there is no contracting means. These are all not relevant nowadays, but still at the time of reinsurance contract origin, there were communication only by means of telegrams and telex. So what happened is at the time of disconnection between these communications, if the disconnection is more than 30 days, it was considered that the communication has been attempted and the communication has been deemed to be done and the treaties will be terminated. Now it is not relevant because the communication technology has developed leaps and bounds. It is not relevant anymore. And any notice of termination, it should be addressed to the party concerned to his head office. Or if any address is mentioned previously in the treaty, the notice of termination has to be sent to that particular address. The reinsurer shall accept new sessions and renew existing sessions in the same manner and in all respects as if no such notice has been given. Once a notice of termination has been given, there will be a time period up to which the notice of termination will be stretching up, and after that expiry of the time period only, this treaty will terminate. During this course of time, any business transacted should be considered normal. The reinsurer should not deny any business put inside during the notice of termination. NCAD, notice of cancellation on anniversary date. For long-term treaties, for yearly treaties, there is always a scope. At the end of the treaty year, there is a scope to change any alterations or do for ask for any corrections. But for a long-term treaty, say if a treaty itself is issued for 3 years or 4 years, what happens is there is no window open for the insurer or the reinsurer to incorporate any change, to communicate any change, or if he is willing to pull out from the treaty, there is no window open. In that case, for long-term treaties, what we will do is there will be an NCAD provision, notice of cancellation on anniversary date. So this anniversary date for a 4-year treaty, every year once this treaty beginning year will come, treaty birth year will come, birth date will come. So at the date of the birth of the treaty, there will be window open for either insurer or reinsurer. At that window, they can either communicate if they want to continue the treaty, if they want to do any changes with the treaty, or if they want to terminate the treaty. So that window will be made open by using NCAD window. So once if a insurer or reinsurer wants to cancel a treaty, he has to adopt 2 steps. One is PNC, one is DNC. So first is provisional notice of cancellation. At least 3 months before the end of the treaty, the reinsurer or the insurer who wishes to cancel or change the terms of the treaty, he has to serve a PNC. It's usually sent 90 days prior to the treaty expiry. Then, if this PNC is not followed up, if it is just kept as is, then it is considered that it is not followed up actively and the treaty continues automatically. However, if there is a definite wish by the insurer or the reinsurer to terminate the treaty, he will follow up the PNC with the DNC, definite notice of cancellation. So, if the insurer or reinsurer wishes to definitely cancel a treaty, he first should issue PNC, then he should issue a DNC, definite notice of cancellation. If a DNC is not given after PNC, it is automatically considered that the treaty is going to continue. There is no need of changes. So that is how this analogy works, PNC and DNC. Sudden death clause. So sudden death clause will be incorporated by either insurer or reinsurer. At the time of the agreement itself, they'll arrive. What are the conditions when the sudden death clause will be invoked? For example, at the time of inception of the policy, the reinsurer will be having a credit rating of A minus. So the insurance company might put a sudden death clause stating that if your rating goes below B, I'll invoke the sudden death clause and I immediately cancel the treaty. Likewise, the reasons can be developed at the time of the inception of the contract, and sudden death clause can be utilized to immediately cancel the treaty. Then alterations by mutual consent. It is similar to policy endorsements, like how we are giving endorsements in our policy. If there is any changes required in the treaty, it is done by passing addendum. Here, instead of word endorsement, we are using addendum as the word. Insolvency of other insurers. This clause is used to limit the reinsurer liability. For example, if the insurer has reinsured with two companies, reinsurer A and reinsurer B, so he has to get 5 crore from reinsurer A, 5 crore from reinsurer B. Yes, sir. Yes, yes.
Sir, what are the circumstances under which this provision is applicable for sudden death clause?
Yes, sir. Sudden death clause, like I mentioned, the situations can be defined by the insurance and reinsurance company at the start of the beginning, at the start of the treaty itself. It can be like a downgrade of the rating, or it can be like certain lines of business like the reinsurer can restrict. You should not do terrorism lines of business in northeastern part of India or northeastern part of Asia. Likewise, he can restrict certain activities. If that activity is done by the party, sudden death clause will be invoked and the treaty will be immediately terminated.
These are written in the treaty.
Yes, what's it?
These are written in the treaty itself.
Yes, yes. At the time of the conceptualization of the document itself, this will be written.
Right, sir. Thank you, sir. Thank you very much.
Okay, sir. Okay. So insolvency of other reinsurers, like I mentioned, if an insurance company has got two reinsurance company support, reinsurer A is having 5 crores worth of liability, reinsurer B is having 5 crores worth of liability. For example, if reinsurer B becomes insolvent, now reinsurer A will be due only for his share, 5 crores. He will not be taking the additional burden of another 5 crores from the reinsurer B. He is liable only for his share. To show this stance very clearly, they use this insolvency of other reinsurers clause. So the loss to a reinsurer will not be increased due to the inability of ceding insurer to collect the loss from another reinsurer. That is how this insolvency clause works. Access to records. It is very similar. Whenever a loss has occurred and the loss is relevant to a reinsurer, he has the right to visit the ceding insurer's office. He has the right to inspect the book of the record, and he has the right to see what is the underwriting done, what are the causes for the claim, what are the investigations done. All these permissions the reinsurer gets by means of this clause, access to records clause, but only for the losses that come under the scope of the treaty. If a loss has occurred and it is not under the scope of the treaty, the reinsurer does not get the right to go and inspect the book of the records of the ceding insurer. Errors and omission clause. So this is to protect the ceding insurer against any inadvertent error or omissions. If the ceding insurer genuinely has lost certain things at the time of inception of treaty, whenever he has come to the knowledge, he should immediately communicate to the reinsurer and he should pass addendums and he should rectify the errors. That is how error and omission clause occurs. Intermediary clause. It is also called as broker's clause. So intermediary clause, what it does is it shifts all the credit risk to the reinsurer. You be very clear with that. Intermediary clause or broker's clause will always shift the credit risk to the reinsurer. How this happens? Because when a ceding insurer pays a premium via intermediary, it will be considered that the moment the ceding insurer has handed over the premium to the broker, it has been handed over to the reinsurer itself. Even though the broker might have remitted it or not, it is considered as it is given to the reinsurer itself. But vice versa is not true. When a reinsurer has to give a claim to the ceding insurer, if you handed over the claim to the broker, that will not be considered as the settlement of the claim. Only when the broker gives that claim amount to the final insurer, only at that time it will be considered as the transaction is over. If, for example, the intermediary gets the claim quantum from the reinsurer and he elopes, it will be considered that the reinsurer is still liable for the claim and he has to pay that claim amount again to the insurance company. So that is how intermediary clause works. Arbitration. So the disputes are very common in treaties also, because a certain thing can be accepted by one company which will not be accepted by reinsurance company at the time of loss. So what happens is disputes might occur. So arbitration clause is there to solve these disputes. So this disputes can be solved by appointing one arbitrator or two arbitrators by both the parties. Or if there is a disagreement between both the parties, an umpire will be appointed. This umpire will be appointed either by these two arbitrators or a mutually agreed authority. Either of these two will appoint an umpire. There is one more clause that comes under the arbitration clause, that is jurisdiction clause. So this jurisdiction clause, what it says is, if an arbitration fails, then there will be there is going to be a judicial proceeding. This judicial proceeding should occur only at the judicial court stationed in the ceding insurer's country. So this is always to the disadvantage of the reinsurer, because this judicial proceeding will always occur at the ceding insurer's country. So the reinsurer has to always visit the court at the ceding insurer's country for every hearing. That is the scenario. Set off clause. So set off clause is given to net off the loss. For example, there is a 10 crore worth of payment to be given by the reinsurer to the ceding insurer, and the ceding insurer has to give some 2 crore worth of payment to the reinsurer. What happens is the reinsurer will net off. He'll pay just 8 crores and he'll net off the transactions. That is net off clause. It is very much used in insolvency clauses, because if there is a payment to be made by the reinsurer to the ceding insurer, for example, 5 crores he has to give to the ceding insurer, and ceding insurer is also liable to give some 1 crore worth of premium to the reinsurer. This is the scenario. Suddenly what happens is the ceding insurer becomes insolvent. Now the reinsurer will pay only 4 crores to the actual required parties. Since the ceding insurer has become insolvent, those who are the claimants who are eligible for that loss quantum, the reinsurer will pay, but he will deduct the 1 crore worth of payment that he is eligible to get from the ceding insurer. This is called set off clause. Then accounting clause. The accounting clause just states on what manner the accounts has to be transacted. Like it will say whether the accounting has to be given in quarterly basis, yearly basis, or half yearly basis, and it will also mention by what period this accounting has to be confirmed by the reinsurer. In general, as I mentioned before, quarterly accounting is preferred by the reinsurers. Then the reinsurer will also confirm, like there will be a fixed duration. For example, once a quarter is finished, the reinsurer will give a window of 3 months period to prepare the accounts and settle it and hand it over to the reinsurer. Once the reinsurer gets this quarterly accounts, he'll analyze this account and he'll confirm it within 1 month from the date of reception. So these are the tags commonly used, but these will vary. This is the most commonly used tag: 3 months, 1 month. Once the quarter ends, within 3 months, the ceding insurer has to prepare an accounting statement and give it to the reinsurer. Once the reinsurer gets the statement, he has to confirm the statement within 1 month from the date of reception. This is the commonly used tag. This is not conclusive. It can differ based on the type of the treaties. Then currency clause. Currency clause is used for used for transactions which involve multiple currencies. For example, since these reinsurance transactions are always inter-country and geopolitical in nature, there will be companies involved with 2 or more countries. So the currencies will be different. So the unit of currency expressed in a treaty agreement, it will always be the domestic currency of the ceding insurer. So who is the ceding insurer? What is his domestic currency? That will be used to express the limits in the treaty. Then the treaty agreement will have a provision which will allow the ceding insurer to invoke one choice. The ceding insurer will get a choice to form the original currencies as the basis of the liability of the reinsurer. Now, what is the original currency? Original currency is nothing but the policy currency. A ceding insurer would have issued a policy. So that policy, for example, a ceding insurer from India would have issued an insurance policy. That insurance policy would have been issued in terms of INR, Indian rupee. So original currency will be Indian rupee. However, there is also a chance where in certain marine business, the Indian insurance company would have issued policies in terms of dollars. Marine cargo, for example, they would have issued policies for exports and imports in dollars. So in that policies, original currency will be dollar, not INR. Even though the ceding insurance is ceding insurer is in India, if he has issued a policy in dollar terminology, original currency will become policy's currency, which is dollars. If he has issued the policy in INR, original currency will be INR. So this is the difference. There are 3 currencies, which is domestic currency, reinsurer's currency, original currency. Domestic currency, you can be very clear. What is the ceding insurer's country? What is the currency of that country? That is domestic currency. Then reinsurance currency, you can very be clear. What is the country of the reinsurer? What is the currency in that country? That will be reinsurer's currency. Original currency is nothing but policy currency. In what terms the policy is mentioned, that currency forms the original currency. So ceding insurer alone has the right to revert partially or wholly to the original currency in the event of any changes in the currency situation. So ceding insurer gets the right either to get the loss in the country's ceding insurer's domestic currency or to get the loss in original currency. He has the right to choose between. Then loss advices and accounting of losses. Any individual losses exceeding and sum insured the ceding insurer may request for immediate settlement of loss by cash loss recovery. So this cash loss recovery facilities and all will be mentioned in loss advisors clause. And if suppose in a situation the ceding insurer is not willing to get cash loss recovery, he is having sufficient cash. But even in that situation, if the loss happened as crossed this cash loss recovery quantum above, he has to report it to the ceding insurer. He has to report it to the reinsurer, even though he is not willing to get the cash loss recovery facility. If a loss has occurred whose quantum is more than this recovery's limit, he has to immediately inform the reinsurer. So that is known as the ceding insurer has to give the loss advice to the ceding reinsurer, which is called as preliminary loss advice. Okay, then business covered attachment sessions are proportional. Then this business covered clause, what it will say is when it is solely used for proportional treaties. So in a proportional treaty, what happens is a session will be done, ceding will happen. So there will be a time lag between accepting a risk and ceding it to the reinsurance policy. What will happen if a risk has been accepted by the original insurer, but before ceding it into the treaty, what happens is there is a claim occurs. Then what will happen? It will be considered that it will be covered. It will be treated as if it has been ceded immediately. The loss will be payable. So that is what it is explained by this business covered attachment of sessions clause. Then for non-proportional treaty, there is one more clause, which is business covered insuring clause for non-proportional treaty. Because in non-proportional treaty, there is no session. There is only reinsured and reinsurer relationship. So what this clause will do is, under what circumstances a reinsurance company has to pay claim. That will be explained in business covered insuring clause non-proportional. The ceding insurer has sustained a loss covered by the reinsurance. Such loss exceeded a previously agreed threshold limit, which is called deductible. In this scenario, the excess of loss cover will be paying the claim quantum. So that is how this clause works. These two are just defining clauses. Under what scenario and what conditions the loss will be payable. That kind of defining scenario is done by these two clauses. Underwriting retention and limits. So it is called the underwriting clause. So underwriting clause, what it means is, during the currency of the treaty, the ceding insurer should not make any changes in his underwriting practice. If he makes any major underwriting practice changes, it should be immediately communicated. If it is not communicated, then the treaty will be terminated. That is what the underwriting clause means. Original conditions follow the fortunes. Everyone knows. Follow the fortunes is how the reinsurance works. Reinsurers purely follow the insurance fate. They do not follow the commercial fate. So that is what it is defined in this original conditions clause. Net retained lines protecting net retention. This net retained lines clause. This clause is also known as the net retained line clause. So what this clause means is, for example, in case of a proportional agreement, consider a quota share agreement. There is a 60% quota share. One sum insured of 100 crore has come in. So 60% quota share means 60 crores will be given to the reinsurer. 40 crores will be retained by the insurance company. Now the insurance company might feel that he might want to have even one more excess of loss cover on this retention portion. This 40 crore itself might feel huge loss for insurance company. So he can devise one more cover like this, 10 crores in excess of 30 crores. So in this case, what he has done is, he has reduced his retention. Instead of paying 40 crores, he has reduced his retention to 30 crores, and for 10 crores, he has bought an excess of loss cover. This kind of provisions are mentioned in net retained lines clause. So that is why it is called as protecting net retention. Purely protecting the net retentions by using excess of loss covers. That is what is explained by these clauses. Reinstatement clause. It is very simple. Whenever a treaty is completely exhausted, it defines whether a reinstatement is available or not. Most probably, the treaties are operated by means of giving one successive reinstatement. Any further reinstatements, it might be either chargeable or it might not be available at all. It will be purely decided at the time of the beginning of the treaty.
Sir, one more question. Sir, one more
Yes,
question.
sir, yes.
Sir, a reinstatement clause is applicable on non-proportional treaty or proportional treaty?
Sir, it is applicable in both, sir. Reinstatement clause is applicable in both non-proportional and proportional.
Okay. Okay.
Okay. PML excess clause. This is what I said, like I'll explain later. There is one PML excess clause. This is where the PML burst comes into picture. For example, there is a PML estimation of 100 crores by an insurance company. But if it has become a wrong estimation, and actually at the time of loss, there is a burst, PML burst, and the loss was actually quantifying to 200 crores. In this case, what will happen is, the insurance company would have got the reinsurance arrangement based on the original PML of 100 crores. For example, let's say 50-50 will be the arrangement. 50 crores retention, 50 crores protection by the reinsurance company. what happened is at the time of loss, there is a loss of 200 crores. Now, the reinsurance company will invoke this PML excess clause. What the reinsurance company will say is, when you have done a wrong PML calculation and the PML burst has occurred, my liability will not be unnecessarily increased because of your wrong calculation. So that kind of restrictions can be put in PML excess clause. Commonly, there is one specimen wording which is used. What is that is, if in genuine case 50 crores retention by the insurance company, 50 crores reinsurance by the reinsurance company, then the loss has become 200 crores. What will happen is the reinsurance company will be willing to pay 50% of his limit as an additional quantum. So what happens is, instead of paying 50 crores, he will pay 75 crores. So the insurance company would have received 50 crore retention and 75 crores from the reinsurance. In total, 125 crores he would have got. So like that, it can be decided between the insurance company and reinsurance company at the beginning of the treaty. So PML excess clause will be invoked solely by reinsurance company to avoid higher loss during the PML burst scenarios.
So
Okay.
there is no
Extension of
mandatory
reinsurance.
limit, sir, for
No,
like
there
just
is
we
no
have said.
mandatory limit. There is no mandatory limit, ma'am. For PML excess clause, there is no mandatory limit. For example, if a reinsurance company wishes not to pay any extra penny, he can very much use this clause and he can say that if there is a PML burst, I will not pay anything in excess of my original limit. Even in that way, he can construct the wordings. It is purely based on the discretion of the reinsurance company. Okay, extension of reinsurance cover. So if a loss occurred at the progress at the time of expiry of the treaty. For example, the treaty is expiring on 31st December 2025. Earthquake incident occurred on 29th of December 2025 and it is continuing to occur up to 3rd of January 2026. What it will be by using this extension of reinsurance cover clause, what we'll consider is, we'll consider that the entire earthquake event, even though it exceeded the treaty period, will be considered as it has completed inside the treaty period, only because this loss initiated before the expiry of the treaty. So the ending of the loss will also be considered as it is inside the treaty scope. That is what the extension of reinsurance cover signifies. Then downgrade clause. The downgrade clause is purely used for rating related downgrades. So by using this clause, a insurance company or a reinsurance company can come out of the treaty agreement by stating that you have got a downgrade in your rating. This is not suitable for me to carry out a business with you. So I am going to terminate my treaty agreement here on. That for these kind of negotiations, downgrade clause is used. Then cut through endorsement. I have explained this cut through endorsement on fronting in my earlier slide. So cut through endorsement, what happens is, there is a 3-point relation, like I mentioned, reinsurer, insurer, original insured. So there is no relationship between reinsurer and the original insured. When this cut through endorsement is used, the reinsurance company can cut through the insurer, and he can directly pay to the original insured by invoking this endorsement. That is called cut through endorsement.
Sir, in extension of reinsurance cover, the 72 hours clause is applicable or not? 72 hours clause is applicable or not?
Yes, sir. Extension of reinsurance cover. No, for extension of reinsurance cover, the 72 hours clause is not applicable at that time, because extension of reinsurance cover purely signifies that before the expiry of treaty, if a loss event has occurred, it can be earthquake or it can be a fire which is engulfing, which is the firefighters are taking 3 or 4 days to complete extinguishing the fire. Only criteria is this loss should have occurred before the expiry of the treaty. So if it has occurred before the expiry of the treaty, even though if it takes 3 or 4 days, it can be considered as it is inside the treaty. There is no hours clause inside this clause. Hours clause is used elsewhere. That is the next clause, in fact. So hours clause is used to define any events that are considered to be by nature they stretch for multiple days. For example, a tsunami or an earthquake, or for example, a volcanic eruption. Very classical example is a volcanic eruption, because even earthquake or tsunami can be one-time events, but a volcanic eruption, once it triggers, it can go for weeks. So in these cases, hours clause is used to segregate the events, to cut off one event into so much number of hours. So there are certain standard hours used in the field, 72 hours for earthquake, seaquake, hurricane, typhoon, tornado, windstorm, rainstorm, etc. And 168 hours for any other catastrophe or whatsoever nature. This can be either RSMD related things or any other catastrophe like that. But these hours can be decided, as I mentioned in multiple clauses before, these hours can be decided at the time of the construction of the treaty, and they can work accordingly. So why this hours clause is used? For example, if an earthquake is occurring and it is occurring for more than some 90 hours. So by using this hours clause, the insurance company will say that I have faced two losses. So my first loss is from 0 to 72 hours. That I will consider as one single loss. From 73rd hour to 90th hour, I'll lodge it as a second claim. That is considered as a second loss. So to segregate these claims, the hours clause is used. It is very much different from the extension of reinsurance cover. This hours clause is used to segregate the number of events. Then index clause. Index clause is because as I mentioned before, there is a transaction between multiple countries and multiple currencies. So the exchange rate fluctuation is very much a potential issue in reinsurance transactions. So what we'll do is at the time of beginning of treaty, we will fix a index. Some particular currency index will be considered as a measure. And if there is a deviation in that index more than 10%, the exchange rates will be revised. Only when there is a deviation of 10%. So that will be the 10% trigger when it is satisfied. The exchange rates will be revised to current rate. That is how the index clause works. So for this index clause, there is a time of claim which is crucial. So this time of claims should be considered as actual payment date by the company. So if a claim occurs and after 6 months the claim is paid, so on that 6th month we have to check the index. On that 6th month, when compared to the beginning of the treaty, if the index has been swinging more than 10%, we have to revise the exchange rate and we have to pay in the revised exchange rate regulations. So in case of a court award, the date should be considered as the date of award given by the court. If there is an appellant court award, then the date of the appellant court award is to be considered for the calculation of the index variation. Then claim cooperation clause and claim control clause, both are helping clauses. Claim cooperation clause purely means the insurance company is asking for the reinsurance company to cooperate in assessing and judging and finalizing the loss. Whereas in claim control clause, the insurance company is asking the reinsurer to completely take over the loss assessment method. Like the insurance company is not willing to adjust the loss, he is asking for the reinsurer to completely take over the loss calculation and settlement. In that case, claim control clause is invoked. Then stamping of policies. So all the Indian documents has to be stamped as per the Indian Stamps Act 1899. So on that basis, for a treaty agreement, if it is executed inside India, it has to be stamped mandatorily. If a treaty agreement is executed outside of India, then within 3 months after its reception in India, it has to be stamped. But when these treaty agreements are executed outside India, there will be normally two copies. One copy is to be kept by the reinsurer, and one copy is to be kept by the Indian insurer. In those cases, the copy that is going to be retained in India alone has to be stamped. The copy to be retained by the foreign insurer, it is not need to be stamped. There is this treaty agreement between two Indian companies. Then in that case, the document stamping is to be done by the ceding insurer, not by the reinsurer, only by the ceding insurer. Okay. Now I'll slowly enter into the basic concepts. These are very basic concepts as far as reinsurance is concerned. That's why I have put it in the farther end of my slide. So what is reinsurance? It is insurance of insurance. It is a pure contract of indemnity between the insurer and the reinsurer. So insurer is the insurance company. Reinsurer is the reinsurance support provider. So
Excuse
the
me, sir.
reinsurer takes. Yes, ma'am. Yes.
Sir, what is run-off clause, sir?
Run-off clause. Okay, the run-off clause actually means that in what way when a particular risk has to be treated as I'll put you in this way. The run-off clause will signify that in what manner a risk has to be considered to be completely out of the accounting book. So what you can put in treaty terms is that a treaty will be having a certain set duration, and that duration, for example, for 1 year duration, multiple claims were lodged, and during this 1 year, those claims that are not paid, they will be carried forward to the next year. So these next year carried forward claims, they will be called as run-off claims. So these run-off claims, what they can be done is, it can be either accommodated in the next treaty, or it can be paid with the original treaty. So this original treaty will be having a set duration called runoff. Up to that duration, all these lost transactions will be booked in the original treaty. After that particular duration, the accounting book of the original treaty will be closed, and the balance remaining losses will be adjusted on next upcoming accounting book. For these duration definition, runoff clause is used. Is it clear, ma'am?
Yeah, thank you, sir.
Okay, ma'am. Okay. Okay.
Excuse
So
me, sir.
technical risk. Yes, sir. Yes.
One question. 50% method.
50% method. What, sir?
Sir, profit mein 50% method.
Yeah, profit commission. Yes. In profit commission, there is one method called 50% method for calculating the profit commission. So what this method signifies is that you consider any single year for calculating the profit commission. So in that single year, what we will do is we take the mean of the year. So what is mean of the year? The middle of the year is called mean of the year. So when you take the middle of the year, there will be 50% of the policies that have crossed their 50% of the lifespan. It is an ideal scenario. At the middle of the year, for example, there is 100 policy in a year, all the 100 policies were issued on 1 January 2025. So if you go at the middle of the year, what will be happening is all these 100 policies would have completed half their lifespan. They will be having half their lifespan yet to be completed. So that's why for considering a profit commission, there is a method called 50% method. This 50% method, what it does is when we are calculating a portfolio, which is live at any point of time, we are referring the mean. The mean is 50%. But in this 50%, there will be procurement costs, there will be management expenses which have to be accounted. This will be around 10 to 15% of the total premium that is yet to be earned. This is linked with the earned premium condition also. So in the middle of the year, you have earned half of your premium and half of your premium is unearned. But in that unearned premium, there is also management expenses, there is also commission costs. So we have to deduct that unearned portion also. So that's why, for example, 100 rupees is the premium for the year. At the middle of the year, 50 rupees you have earned. Another 50 rupees you have not earned. But this 50 rupees will not be considered as the unearned premium completely. There will be provision given to commissions, which is 10% or 15%. There will be provision given to management expenses, which will be in combination 10 or 15%. So out of the 50 rupees available, this 15% will be deducted. And the balance 35 rupees will be considered as the next carryable portfolio. That is why we are using 50% method. Is it okay, sir?
Okay, sir.
Sir, what about 1/24th method? 1/24th method?
Yes, 1/24th method and all were used for these are all methods primarily used for movement of portfolios in their first reason. They were discovered for movement of portfolios and they were adopted for various other calculations. So this portfolio transfer can be done easily by 50% method. There is also other method called 1/24th method, 1/8th method or anything. For example, in 50% method, what I said is you are taking one single year and you are taking that single year and going for mean in the middle of the year. So 1/24th method is instead of taking one single year, you take every month. And every month you take the middle of the month as a mean. Then there will be 2 points, middle of the month and end of the month as 2 points. For example, on 1 January, you have booked a premium, which is quantifying for 10 rupees. In the middle of the month, that premium would have extinguished its half-life. In the end of the month, that premium would have extinguished another half-life. So like that, for each month, there is 2 segments. For 12 months, there will be 24 segments. So for 24 segments, what we are doing is for every month, we will calculate the rateable proportion of the premium of that month. And that rateable proportion of premium will accumulate and will calculate at any point of the year. For example, if you are requiring to move a portfolio at the end of December, what we'll do is we'll go for 1/24th of the premium to be moved. So that is how this 1/24th method or 1/8th method works. It is used to move a portfolio from 1 year to another, and it is used to decide how much of the portfolio I have to move from 1 year to another, so that I can calculate the earned premium, and so that I can calculate the unearned premium to be transferred to the upcoming treaty. So in basic, what we are doing is when a treaty has been terminated and when other treaty has been originating, the carryover provision from one treaty has to be moved to the next treaty. To identify how much I have to carry to the next treaty, I am using all these methods, either 50% method or 1/24th method, 1/8th method, 1/12th method. Everything I am using solely to identify how much I have to carry over from one treaty to the next treaty. So these are all the methods that are used, and based on the business and based on the LOBs, the methods will be chosen by the insurer.
So 50%
Be
method
chosen by the
for one
insurer.
more time, please tell shortly.
What, ma'am?
50% method, just tell one more time.
50% method is nothing but you are taking 1 year as a one fixed duration. On 1 year, you have booked 100 rupees worth of premium. So in the middle of the year, what would have happened is you would have earned 50% of your premium. Earned premium concept has to come. So in the middle of the year, 6 months have eloped. So for that 6 months, you have earned the premium. Half the premium you have earned. So 50 rupees has been earned by you already. There is no loss in that. If there is no loss in that 6 months, there is no loss paid by you from the premium. That 50% of the premium is completely earned by you. It is your share now. Now there is another 6 months to be extinguished. But that 6 months, for that 6 months, we have 50 rupees worth of premium, which is there kept there for paying any losses if those losses occur. Now what happens is we are terminating a treaty and we are beginning a new treaty in the middle of this time. So what I have to do is I have to move this unearned premium to my new treaty. So how I can move this unearned premium? I can blindly move this 50 rupees to the unearned as unearned premium to the new treaty, but that is not the case to be done so, because in our premium there is always commissions, there is always management expenses. So we have to make adequate provisions. There is a universally accepted proportion which is 10 to 15% of the premium should be considered as management expense and commission expense. So for that, on the remaining 50 rupees unearned premium, we are reducing 15%. So if you are reducing 15%, you will be getting the quantum of 35 rupees or 40 rupees. 10 or 15% based on that, you will be getting 35 or 40 rupees as the unearned premium. Only this 35 or 40 rupees will be moved to the new treaty, not the entire 50 rupees. For this calculation alone, we are using this 50% method. These 50% method, 1/24, 1/8 method, all these methods are solely used to identify the quantum of amount, the quantum of premium that has to be moved from one treaty to next treaty. I think I have delved too much into these concepts, so I'll move on to other concepts. Okay, so reinsurance mainly looks after technical risk and contractual risk. You will be very much aware what is a technical risk. It is purely the risk that comes from the insurance contract, inherent risk undertaken by the reinsurer. So if a loss occurs in any insurance policy and if it is falling under the scope of the reinsurance contract, the reinsurer will pay his share of claim. Simply this is called as technical risk. Whereas contractual risk is somewhat different. Contractual risk is attributed to these exaggerated claims, fraudulent claims, unjustified claims. For example, if an insurance company has given a motor vehicle policy and the original insured has duped the insurance company itself. He got a fake document and he created false documents and he received the claim. In this case, what will happen is for the insurance company, he will not know if it is a fake claim or not. He would have paid the amount. Similarly, once this payment has been done, reinsurance company will also pay his own share of claim. He will not come and investigate separately for each and every claim. So that is what is called as contractual risk. It is inherent inside the reinsurance contract. Then other risks emanating from the insurer or reinsurer, it depends on the working principle of the insurance company. If one insurance company will be considered as working very good with proper discount levels and proper underwriting methods, another insurance company will be considered as going very much rogue into the market, very much disrupting the market with the unviable rates and all. So these kind of problems are there in reinsurance. If a reinsurance company has given support to a rogue insurance company who is not having proper underwriting methods, he is going to suffer. So these are the risks in the reinsurance. This beyond the control of the contracting parties. So these will be classified as exchange rate fluctuations, inflation, taxation, etc. So these kind of fluctuations are beyond the control of both insurance companies as well as the reinsurance company. So these are termed as beyond the control of contractual parties. Then risk inherent to reinsurance, accumulation hazard, because reinsurance by default work on geographical scale. So for example, a reinsurance company would have insured the entire part of the India's property risks. If earthquake occurs in any one single portion of Indian subcontinent, what happens is the entire property business of that area will be triggering claims to the reinsurance company also. This kind of accumulations is inherent in reinsurance. To avoid this accumulation only, the reinsurance company, what they'll do is they'll try to spread their wings as wide as possible across multiple countries, so that one premium from one country will be used to offset the claims from another country. That is why the inherent nature of reinsurance is to spread the wings across the globe. Then functions and advantages, it is very basic because the reinsurance arrangement provides increased capacity to the company. The financial stability and the claim ratio of the ceding insurer will be very much better with the support of the reinsurance company, because without the reinsurance, the ICR will shoot up like anything and his stability will be very bad. If with the protection of reinsurance, he can have a balanced portfolio. So he can minimize the accumulation of losses across the LOBs. It increases the geographical spread of the risk, because an Indian risk will be spread across a European insurer or anyone like that. Then it protects the solvency of the ceding insurer. Solvency margin norms has to be met, which with the help of reinsurance contract, the solvency margin will be safeguarded. Increases the capacity of the ceding insurer. It enables the insurance company to work on a large scale. Even though the capital is very small for the company, he can work on a large scale with the help of the reinsurance. It helps the insurer to explore newer LOBs. For example, very recent example is our war on land cover. So far, no company has entered into this LOB. Now, New India has entered into this LOB. So, New India cannot solely enter into this LOB without proper reinsurance backing. So, reinsurance helps the company to enter into newer LOBs. So, forms and methods. So, you just have two acronyms, FFT and MMN, because so many I have found that forms have so many people are confusing the forms with methods. So, forms are always facultative and treaty. FFT, forms, facultative, treaty. And methods of reinsurance is always MPN, methods, proportional and non-proportional. So facultative, everyone will be knowing it is a one-off or option to, it is a one-off individual reinsurance. So there is option for both the parties. Ceding insurer has the option to cede, the insurer has the option to accept or reject. Fac reinsurance is required for mostly required for major risk, because for smaller risks, if we are going
please
for
back your
facultative
slide.
reinsurance. What's it?
Sir, please back your slide. Earlier slide.
Yes. What do you want to know on this slide, sir?
So just reading.
Okay.
The type is also proportional, non-proportional.
What, ma'am?
If they ask about type of reinsurance, so is it non-proportional?
Yes, types of reinsurance is proportional, non-proportional only. Only forms is facultative and treaty. Okay, I'll move across.
Sir.
So facultative reinsurance, the reinsurer has the option to accept or reject. It is used in more larger risks. For a smaller risk, if facultative reinsurance is used, it is going to be expensive, because each and every risk has to be consulted with the reinsurer, and the terms has to be sought after, and then only he can go for or insuring the risk. So it is a time-consuming, cumbersome process. Facultative is reserved for larger risks and for those risks which cannot be covered under treaty. Then limitations. Facultative in reinsurance needs skilled personnel, because only large risk will be flowing towards facultative arrangements. So the personnel should be very skilled to know what is what. High risk proposals will be coming under the purview of FAC. All the FAC proposals will have to be handed on case-to-case basis only. So the administrative work is high. TAT is also very high. It is not suitable for insuring large number of risks, because if the large number of risks has to be insured in facultative terms, it is going to be very time consuming. Then forms of reinsurance. Treaty is the major development. Because of the treaty reinsurance, many companies have went into the reinsurance venture, and many companies have successfully stabilized and strengthened their foot in insurance market. So it is an agreement between the insurer and the reinsurer to accept all the risks falling within the scope of the agreement. So this contract is an obligatory contract. Once a treaty has been entered, within the scope of the treaty, whatever the risk comes, the insurer has to pass into the treaty. Similarly, the reinsurer has to accept mandatorily if it is coming inside the scope of the treaty. They don't, both of them don't have the options to remove the risks that are coming inside the scope of the treaty. So advantages, limitations are present in treaty also. Advantages is that it is a single agreement. It is automatic. So all risks falling under the treaty will be automatically protected. There is no need for individual session to the reinsurer. It will be considered as automatically protected. So an insurer can purchase multiple treaties for multiple LOBs. Motor LOB, he can purchase a treaty from one company. Another company, he can purchase LOB for miscellaneous LOB, like that. Limitations is that there is always a form of moral risk. Example, if the insurance company is having poor underwriting practice, he is very generous in issuing claims. What will happen? Treaty will suffer badly. Reinsurer will find the results in accounting, and he will just pull off from renewal of the treaty next year. That is the issue. Special form is a facultative obligatory reinsurance. We call it as FAC-OB. So it is a combination of facultative and treaty form. It is available only in soft markets. So in insurance, we will be very, I hope everyone will be aware about hard market and soft market. So a market is considered hard when the premium rates are very high, discounts are very low, because the claims would have been very high on the precedent years. The companies would have decided that they should not give much discounts. So premium will be very high. The market will be considered as hard. But during soft markets, the premium will be very low, because there would have not been much claims in the previous 4 or 5 years. So the insurance company will be having sufficient surplus to pay claim. In that time, what they'll do is they will go for much higher amount of discounts. The coverages will be easily available. Whatever the terms and conditions will be easily flexibly available. And only in those kind of soft market conditions, an insurance company can obtain facultative obligatory reinsurance. Why so? Because this FACOP provides option only to the insurer. The insurance company gets an option either to cede or retain a business. But if the insurance company wishes to cede a business, the reinsurer has to accept. He has no option to reject. So it creates an adverse selection against the reinsurer. That is why this FACOP reinsurance is not available in normal market. Only during soft markets, where the company is very eager to provide whatever the cover is required, they will be okay to provide FACOP reinsurance.
Sir, how should be the market?
Yes, sir.
Soft or hard?
Yes, sir.
How should be the market? Soft or hard?
The markets will always be cyclic in nature, sir. There will be not an ideal condition, because if there is a hard market throughout the lifespan, people will find that insurance is very costly affair. They'll just go off from insuring any risks. Insurance field itself will become dwindled. So the market will be very much cyclical in nature. Similarly, soft market cannot be the norm always, because if we are having very low rate across for the past 10 years, instead of having proper actuarial calculations, we are charging lower rates for the 10 years. In 11th year, a major catastrophe comes, the entire book of the business will be wiped out, and the insurance company will be in toes of government support. So the market will be always cyclical in nature. Based on the ICR, the market will be slowly shifting. Now, currently, we are in soft market because the property lines have opened up. All these companies are going very hard on discounts. So the current market is in soft condition. It is always expected to have 3 to 4 years of soft market, followed by 3 to 4 years or 2 years of hard market. Hard markets usually last like shorter span, because in hard market, even though if it is existing for 2 years, the premiums will be very high. The insurance companies will be getting the premium very quickly for them to support and get adequate surplus. Then the market will slowly open up towards the softer side. This is a cyclical pattern. There is no set standard.
In this form, premium rates are very high now.
What's it?
In this facultative obligatory, premium rates are very high now.
No, in FACOP, it is obtained during soft markets, so the premium will be lower. Only during soft market, the reinsurance company will be willing to give any kind of cover. When an insurance company approaches, he will be ready to give whatever the cover he wishes for. So in those kind of conditions, he will be okay to go for like a FACOP reinsurance. The rates will be lower, but not everyone will be obliging to give this cover.
Oh, sir.
Okay. So proportional methods of reinsurance. In proportional, there are two methods of reinsurance, either quota share or surplus. So what is this proportional? This proportional signifies that sum insured, premium, claim, everything will be shared in same proportion. So I have instead of going for this theory, I will just explain how this proportional concept works. So first, let's go into the quota share reinsurance. In quota share, what happens is the reinsurer assumes an agreed percentage of each risk and shares all the premiums, losses accordingly in the same percentage. So premium and claims are subject to same percentages. This choice of retention percentage is determined as a part of reinsurance program design. So only the ceding insurer will decide what percentage he will wish to retain and what percentage he wishes to reinsure. Since the reinsurer participates in all the risks, the ceding commission is highest for the quota share. This is the universally accepted thing, because once the quota share agreement has been entered, whatever the risk comes into the under the scope of the treaty, everything will be put up inside, and the reinsurer will be getting very good volume of premium. So naturally, he will give higher commission for quota share risks. So I'll give you an example in the next slide. An insurer enters into a 40% quota share treaty with a reinsurer. Gross written premium is 50 lakhs. Gross incurred losses is 32 lakhs. Now the questions are, how much premium is ceded to the reinsurer? How much premium is retained by the insurer? How much loss is paid by the reinsurer? How much loss is retained by the insurer? So in this case, there is a 40% quota share treaty with the reinsurer. So what happens is ceded premium is 50 lakhs. So in that 50 lakhs, 40% will be given to the reinsurer. That is 20 lakhs will be handed over to the reinsurer. Now retained premium will be 30 lakhs. 20 lakhs we will give to the reinsurance company. Balance 30 lakhs we will have it in our pocket. Once the loss comes, it is 32 lakhs. Now, in what proportion we have apportioned the premium, in that same proportion we have to apportion the loss also. So since we have given 40% of premium to the reinsurer, the 40% of losses also will be payable by the reinsurance company. So on the 32 lakhs worth of loss, 40% will be paid by the reinsurance company. Balance amount of loss will be paid by the ceding insurer. This is how quota share works. So we have to find the proportion. This proportion has to be maintained in premium, in sum insured, and claim. Everything has to be working in same order. You should not change the proportion. Then layered quota share. For example, if there are two quota share insurers and they are working on multiple layers, what will be the scenario? So that is what is signified in this problem. An insurer is having two quota share treaties applied sequentially. There is a treaty A of 30% quota share. There is a treaty B of 20% quota share, which applies to the remaining business after the treaty A. So now the gross premium underwritten is 1.2 crores. Gross loss occurred is 96 lakhs. Now what we have to find is the premium and losses ceded to the each reinsurance company, total retention of the premium and losses. So what is given here is 30% of premium is ceded to A. So total premium is 1.2 crores. On that 30% will be ceded to reinsurer A. Losses ceded to the reinsurer will be 30% of the total loss. So 96 lakhs is the total loss. Out of that, this 30% will be shared by the reinsurer A. Now remaining after A will be, we have to deduct the 36 lakhs from the 1.2 crore. So remaining after premium remaining after the A will be 84 lakhs. Similarly, loss remaining after A will be 67.2 lakhs. Now the reinsurer B comes into picture. The premium 84 lakhs is the remaining premium, and that 20% is the quota share undertaken by the B reinsurer. So he will be undertaking 16.8 lakhs worth of sum insured. When on the remaining loss, 67.2 lakhs is the remaining loss. On that remaining loss, 20% will be paid by the reinsurer B. So on that 20% will be 13.44 lakhs. It will be paid by the reinsurer B. So the retail
previous
premium,
slide.
how?
So please
Yes,
show
yes.
previous
Yes,
slide.
yes, yes, you can.
Okay.
Treaties were executed. Yes. So the retention is very simple. Total premium is 1.2 crores. Reinsurer A has got 36 lakhs, so you have to reduce the 36 lakhs. Reinsurer B has got another premium of 16.8 lakhs, so you have to reduce that. So the retained premium is 67.2 lakhs. This is retained by the insurance company. Retained losses. So total loss is 96 lakhs. 28.8 will be paid by the reinsurer A. 13.4 will be paid by the reinsurer B. So balance 53.76 is the retention loss to be borne by the insurance company. This is how the sequential quota share will work. Next, we'll go for surplus reinsurance. Surplus is also a proportional method, but instead of going for a fixed percentage, we will go for a retention in terms of line. So the ceding insurer will decide what is the amount of retention he wishes to retain. It will be purely expressed in amount instead of percentage. So that retention will be called as line. Then he'll go for purchasing surplus treaty from a reinsurance company. He'll get the coverage in terms of lines. For example, he can ask for a 10-line surplus treaty. The insurer's retention is 5 lakhs. So since the insurer's retention is 5 lakhs, it will be considered as line. 10 line means 5 into 10, 50 lakhs worth of capacity is provided by the surplus. Now, a sum insured of 30 lakhs worth of premium is entering into the treaty. For that, premium is 50,000 and claim occurred for 4 lakhs. Now, how will this be apportioned? Remember one thing, for surplus reinsurance, whenever a problem is given, you have to first find out the proportions. Since this is a proportional reinsurance, you have to find out the proportions immediately. You should not think like the insurer's retention is 5 lakhs. Since the claim is 4 lakhs, the insurer will retain completely inside. It is not the analogy. You have to find out the proportions immediately and you have to apply the proportions on all the quantums. So let's consider this case. Retention is 5 lakhs. So total sum insured is 30 lakhs. So retention's proportion is 5 by 30. 16.66 is the retention proportion. Surplus is 10 lines, which is 50 lakhs capacity. So proportion is out of 30 lakhs, 5 lakhs is retained. Balance is 25 lakhs. Only 25 lakhs is available. But surplus capacity is up to 50 lakhs. Here it is not utilized fully. So the balance 25 lakhs is taken for surplus. So you have to find out the share of that surplus. So 25 by 30 is the proportion of surplus contribution. Now the retained premium. 50,000 is the premium put inside. You have to take this 16.66%. Retention percentage is 16.66%. So premium you have to segregate 16.66% of 50,000, which is 8,330. Then 83.34% of premium will go to the reinsurer, which is 41,670. Again, claim will also be in the same proportions. 16.66% of claim will be retained by the insurance company. Then 83.34% of claim will be provided by the reinsurance company. So remember, every time you approach a surplus problem, you have to immediately find out the proportions, and using that proportions, you have to analyze how much of premium should be segregated, how much of loss to be segregated. So that is how surplus works. Proportional insurance, reinsurance, nuances. Certain points I have just constructed. In surplus, the insurance company has the option to reduce its retention level. For example, in the previous problem, the retention is what's up? Okay. In surplus, for example, the retention is set as 5 lakhs in this example. If in a particular risk, if the insurer wishes that this risk is very much favorable, it is not loss prone, he can reduce his limit as 3 lakhs retention. He can reduce his he can reduce his retention as 3 lakhs. So what happens is the lines will be automatically recalculated. If the retention is 5 lakhs, surplus capacity will be 10 lines, so 50 lakhs. If the retention is 3 lakhs, the surplus capacity itself will become 30 lakhs. So this option is given to the ceding insurer only in surplus insurance, because in quota share reinsurance, once a percentage is fixed, it is fixed all throughout. If it is fixed as 40%, it is 40% all throughout. But in surplus, the ceding insurer has the option to adjust the retentions. He can either increase the retention or decrease the retention, and based on that, the lines will be recalculated. So this option is there in surplus. So that's why reinsurance commission in surplus is always less than reinsurance commission in quota share. Then instead of going in sum insured basis, it is best to work with PML basis. This we have already learned. PML basis is very much helpful. Only thing is this PML has to be properly assessed. Otherwise, PML burst will happen. Then board racks. Then board racks is nothing but a statement containing various details about the treaty. It will be shared by the ceding insurer to the reinsurer. So there is an acronym NPS cap. Name of the insured, premium rate and cedent's retention, sum insured, class of risk, amount reinsured, period of insurance. All these things are constituted inside the board racks. So you can get a claim, you can get a question like what are the components insured, what are the components constituted inside a board racks. So you can
Sir,
have
my
this
question,
acronym.
sir,
Yes,
my
yes,
question in this, you are saying in quota share, we take the percentage,
yes, ma'am. Yes,
and
yes,
we distribute the premium and losses accordingly in the percentage manner.
yes, ma'am.
Next,
Yes.
next thing you told us, in surplus treaty, we take the lines, retention,
ma'am.
what
Yes,
is the
yes,
retention,
yes.
then we take then we put the percentage.
Nothing.
How the
Actually, the thing
premium
is,
and sum insured will be distributed among. So then we take the percentage here. You are taking percentage. So I little bit confused.
Okay.
We will take the lines and we will take the percentage.
Okay, the why it operates so is that in surplus, the lines is purely used to explain the capacity of the reinsurance. It is not there to explain the proportion of the reinsurance. Lines are used to explain how much capacity is available, but it does not give you the proportion of retention or reinsurance. That is why we are going for percentage to get the proportions. Since this is a proportional method, we always have to go for proportions. Lines are purely used to express the capacities. Okay, ma'am?
So, sir, how the loss will be distributed? If the retention is 5 lakhs or 10 lines are there for 50 lakhs, if the loss is 25 lakhs, though how the things will be distributed? 5 lakhs will straightforward go to.
No. That is what I have said. You should not directly minus the retention.
Okay.
If a loss is 25 lakhs, what you have to do is that's why we are finding the proportion at the beginning. At the beginning itself, you have to take what is the retention, what is the sum insured. Okay, ma'am. So based on that, you have to find two proportions. That is what I have done.
Okay, sir. It's mean
on that proportion only it should be adjusted.
we first put the capacity and total capacity, what is our retention and what are the lines available. At the time of loss, we see how the premium are distributed among the two surplus and net retention. And again, the losses are also distributed accordingly.
The same proportion. Yes.
In same
That is why
proportion.
these methods are called proportional methods. Yes.
Okay. Okay, sir. Thank you.
So NPS cap is an acronym used to constitute what are the components inside a board racks. In quota share, there is an option to go for variable quota share based on sum insured or PML. So this quota share, like how we have seen in sliding scale commissions, similarly there is a quota share treaty where there is an option for sliding the variable quota share percentage. So based on the sum insured, this quota share percentage will increase. If the sum insured increases, the quota share percentage will be increasingly allotted, or it can be decreased based on the PML, like that. It will be decided by the insurer and the reinsurer. The higher the sum insured or PML, lower will be the retention, because For a higher sum insured, the insurance company will think that it can retain only smaller portion because his capacity will be small. So he'll automatically lower the retention. Likewise, this quota share variable quota share percentage will work. For any reinsurance company, it is a hard written rule. A quota share treaty is any day more profitable than any other means of reinsurance, because in quota share, the reinsurer receives each and every risk into his book of account. So there is no selection against reinsurer. He'll be getting very good amount of premium revenue. That is why the reinsurer is ready to pay more commission for quota share business. But in the same lines, this quota share treaty is always suitable for short-term and specialized arrangements. Because for a long term, an insurance company cannot afford to just keep on passing 60% of the premium to the reinsurer. Then he'll be not having the base to build his capital. So what happens is quota share will always be preferred for new lines of business for a shorter term and for specialized arrangements. That you have to understand.
Sir.
Okay. Now, this is the last part of my slide, non-proportional reinsurance. It is very much important because non-proportional reinsurance is what made the reinsurance market very much accessible in terms of multiple layers. So non-proportional reinsurance will be always done in layers. There will be one layer above another and another layer above another, like that. It will be called as layering. So what's non-proportional insurance is? It is known as excess of loss reinsurance. It is expressed as either XL or XOL. The position of ceding insurer becomes as reinsured. So here the wording itself differs. Until in proportional policies, we have the wording as ceding insurer and reading insurer. Sorry, and reinsurer. Very sorry. It is ceding insurer and reinsurer. But in non-proportional insurance, the terminology completely becomes different. Reinsurer, reinsured. Similarly, how in insurance policy there is insurer and insured. In non-proportional reinsurance, there is reinsurer and reinsured. You'll know why this change of relations is there. For example, there is a XOL agreement which states 1 crore in excess of 50 lakhs. So this expression has to be read like 1 crore in excess of 50 lakhs. So when there is a claim in excess of 50 lakhs, there is a protection available up to 1 crore capacity. So if there is a claim of 1.5 crores, what will happen is first 50 lakhs will be the excess or deductible. The excess of losses, that excess point is always called as excess, deductible, underlying, or priority. All these words mean one single thing. So in this expression, 1 crore in excess of 50 lakhs means 50 lakhs is my retention. That is 50 lakhs is my deductible. After that 50 lakhs, up to 1 crore, another 1 crore, I can get cover from the reinsurance company. So that is what this non-proportional reinsurance signifies. This expression signifies. So this method of non-proportional reinsurance, there are multiple methods in which XOL is transacted. There is working risk, per risk, facultative XOL, CAT XOL, stop loss XOL or XL ratio, aggregate excess of loss, whole account excess of loss, umbrella excess of loss. I'll explain what is what in a small gist in my upcoming slides. So working risk excess of loss or risk excess of loss. Working risk excess of loss is also called risk excess of loss. This is used to protect day-to-day accumulations. For example, accumulations can occur in two ways. A catastrophe might strike and a huge chunk of claim might come. That is not a day-to-day accumulation. It is a one-off accumulation. That is not governed by the working excess of loss. This is working excess of the loss governs on multiple smaller accumulations. For example, a train accident. In a train accident, there might be a trigger of 30 or 40 PA policies where there are for 30 or 40 injuries or death cases reported. This will be an accumulation, but it is a small scale accumulation for an insurance company. In these kind of scenarios, the insurance company can go for working risk excess of loss covers to avoid this kind of accumulation related claim quantums. Then per risk excess of loss. This is used to protect the increased retention level and proportional reinsurance. For example, if an insurance company is having surplus treaty for fire line of business, so every property insurance will be put inside the surplus reinsurance. What happens is while putting all these property insurances inside, there is one particular insurance given for a factory which is very much claimable or very much explosive in nature. So what happens is this particular risk will be having high capability of loss. Then the insurance company can try for taking per risk excess of loss in this case of risk. Why so? Because in surplus or in case, let's for ease of understanding, I'll go with quota share. In a quota share, there is a, for example, there is a 80% quota share agreement by insurance company. So whatever the fire line of business comes inside, there will be 80% of risk shared with the reinsurer. Only 20% will be retained by the insurance company. what happens is one risk comes inside. This particular risk is about a explosive factory, arms explosive factory. So the insurance company thinks that there is very high probability of loss. So even 20% retention is going to be very huge for my affordability. So what they'll do is they'll, as usual, they'll place 80% with the quota share. Then 20% they'll be having as retention. Then what the insurance company will do is they'll take per risk X of loss cover. So this 20% retention, what they'll do is, for example, this 20% retention itself is 200 crores, for example. Then what the insurance company will do is it will take per risk X of loss and it will get a protection like 150 crores in excess of 50 crores. So 200 crores will be the retention originally. By taking this excess of loss, he has obtained 150 crores protection by excess of loss method. So his net retention will be only 50 crores. So when a claim comes, 50 crores only will be his part of payment. Another 150 crores will be paid by the excess of loss reinsurer by this per risk excess of loss. So you just understand the concept. This per risk excess of loss cover is used to protect the increased retention level under a proportional reinsurance. If any particular proportional reinsurance, any particular property will be suffering by increased retention level, you can protect that increased retention level by using per risk excess of loss. Then fac excess of loss, very similar to facultative
Sir,
reinsurance.
excuse me.
Yes,
Sir, in this
yes, sir. Yes.
per this
Yes, ma'am.
excess of loss,
Yes,
after this excess of loss, this 50 crores is retention, and the original is retention also is 50 lakhs, na? Because 200 is the remaining after the quota share, 2 crores is his retention. Out of 200 crore, he did the excess of loss is the 150 crore. So
Yes,
50
yes, ma'am.
crores is remaining. So his total
Yes.
liability is the 50 plus 50. So 100 crores is liability.
No. It does not work like that. The 200 crores will be the original retention, right? So in that
Okay.
200 crore original retention, when he executes an arrangement, he'll execute like 150 crore in excess of 50 crore. That will be the expression.
Okay.
So first 50 crore he will pay, balance 150 crore excess of loss reinsurer will pay.
Okay. Understand.
So FAC XOL is very similar because for any one-off risk, if the insurer wants to go for facultative excess of loss cover, he can go and get a excess of loss cover on single individual basis. Then catastrophe excess of loss, I have informed about this multiple times in previous slides, because catastrophe excess of loss is purely there to protect accumulation losses arising from a catastrophe event. So for this catastrophe excess of loss, there is one warranty specifically applied, which is called two-risk warranty. This two-risk warranty states that at least two risks have to be affected by one event. One event is any catastrophe event. It can be earthquake, it can be seaquake, it can be a storm or anything. By one event, at least two risks have to be suffered in same time. Only then this catastrophe excess of loss cover will come into the picture. It is there to
Sir.
segregate this excess of loss cover. Yes, ma'am. Yes.
So just I want to be clear that catastrophe doesn't mean natural perils like earthquake or STFI, something like that, or
Yes,
other
yes.
risks are also covered there.
Catastrophe here primarily means natural calamities, ma'am. In excess of loss, it is only natural calamities.
If, for example, there is a petrochemical plant and there is a huge loss there, will it come as a catastrophe or not?
No. Because of the English terms, we are calling that as a catastrophic loss of a petrochemical plant. But here that analogy is not taken. This is solely natural calamity, excess of loss.
Okay. Thank you, sir.
That is why we are using two-risk warranty. One catastrophe event, which is identified catastrophe event, a natural calamity must occur. And because of that natural calamity, at least two risks have to be suffered. Then this cat XOL will be triggered. Okay. Then stop loss. Stop loss is nothing but protecting our ICR. We can simply say that up to 90% ICR I will bear. Once 90% ICR trigger is reached, the reinsurer will come into play and he'll give all the claims above 90%. But always the reinsurance company will have an upper limit also. For example, he'll be putting a cover at he'll be putting upper capping at 150%. So once my ICR crosses 90%, my claims will be paid by the reinsurance company up to the extent of 150% ICR. Once my ICR crosses 150%, any claim above that ICR will be again reverted to my insurance company itself. That is how the stop loss excess of loss cover will work. The similar stop loss excess of cover, when it is expressed as a monetary term, it is called aggregate excess of loss. If you express it in percentage, ICR, if it is expected in if you express the ICR in percentage, it is called stop loss. When you express the ICR in quantum, it is called aggregate excess of loss. Both are same, just the expression changes. Then lastly, whole account excess of loss and umbrella excess of loss. Whole account excess of loss is a type of stop loss. It is a single composite cover because it is mostly used in LOBs where multiple type of policies are present. Very common example is miscellaneous LOB. You have poultry, you have cattle insurance, you have burglary insurance. Everything is nestled inside the miscellaneous LOB. So in miscellaneous LOB, there are multiple departments and you want to use one single cover to protect all these departments. In those cases, you can go for whole account excess of loss. Then finally, umbrella excess of loss. Once the insurance company has got all types of excess of loss cover, then he will take an umbrella excess of loss cover. This is taken solely to cover any gaps in the arrangement. For example, in a fire line of business, he has taken one particular excess of loss. In that same fire line of business, there is also loss of profits insurance. For the loss of profits insurance, he has taken another excess of loss cover. But there might be some small gaps between these two covers. To plug these gaps, he can take an umbrella excess of loss cover, which will be covering entirely all the insurance covers. So it offers additional protection over and above the catastrophe excess of loss. So you can imagine at what layer the umbrella excess of loss will be taken. Even above the catastrophe excess of loss layer, this umbrella excess of layer will sit. So it is the last excess of loss layer which will be triggered at the extremely highest loss event. So that's all are the types of excess of loss reinsurance. Then reinsurance program design objectives, you remember one small acronym RFR. The primary objective of a reinsurance program design is to reduce the ruin, to stabilize the fluctuations of the claim experience, to make the insurer to accept risk beyond its retention. So to make the insurance company to accept a risk which normally he cannot even think about. With the help of reinsurance support, he can go and undertake that risk. That is the objective of the reinsurance. Technical objectives are there. Technical objectives are purely technical. For example, it helps in reducing the fluctuations in claims, and it helps to avoid risk of suffering a greater liability in case of financial resources in the event of catastrophe. In a catastrophe event, the insurance company would have thought he will be incurring 500 crores, but due to the happening of catastrophe, he might have ultimately ended up with 700 crores worth of loss. With the help of reinsurance, he can recover those portions. Then concentration of risk in one class of business or geographical area must be reduced. It is a common thing. We should not make a concentration of risk in any kind of insurance or reinsurance for that matter, because concentration is always detrimental for spreading the risk. We should aim for spreading the risk more and more. Role of intermediaries, it is purely the role of broker. Why the intermediary is there in reinsurance? Even though there is a communication now where insurance company can directly contact a reinsurance company, still there is a broker inside the market. This is because a broker has multiple advantages. He can ruthlessly go and negotiate with the reinsurance company. Moreover, since he will be in constant touch with the companies, he will be having the idea if there is a lead insurer and following insurers required, who he can contact, who will be following this particular insurer. All these data he will be having. That's why intermediaries are very much important even today. Then the intermediary will be the one who will be taking the slip and who will be passing across the globe to sign down the slip. Signing down the slip means acceptance of the reinsurance. So the broker will present the slip to each of the reinsurance company. He'll ask them to take a share of the risk. Once all the share of the risk has been taken, he'll conclude the reinsurance cover. He'll be then moving over to the issuance of the policies and all. So reinsurers on higher surpluses and on the facultative reinsurance examine the adequacy of rate levels. So this is the important point. Generally, for first surplus treaty or lower level of reinsurance covers, the reinsurance company will not look into the underwriting factor, will not look into the proper adequacy of rate and all. But once you go for getting higher and higher coverage, the reinsurance company will definitely look for, if he is asking this much of coverage, is his underwriting practice very good? Is he charging adequate rate? Like every kind of like anatomy, it will be coming into picture on higher level of surplus treaties or a higher level of reinsurance agreements. Then signing rules of the reinsurance contract. If it is a facultative reinsurance policy, it is always signed by the reinsurance company. If it is a treaty wording, which contains reciprocal undertakings, if it is a reciprocal undertaking inbuilt treaty, it will be signed by on behalf of the each parties. Then treaty wordings. Once a treaty, we have spoken much about treaty agreement, but treaty agreement is just a simple plain agreement in a bond paper. So it will be having wordings. Those wordings will describe what will be the scope of the cover, what will be the conditions under which claim is payable. It will also have what will be the accounting procedure going to be followed, how my portfolio will be moved, either by 50% method, 1/24 method, what will be the method I will be using for portfolio movement. then border acts, etc. Everything will be considered on that aspect. Proportional and non-proportional forms of reinsurance differ in concept. So therefore, treaty wordings will also be different for these two forms. Treaty wordings, there is no standard form of treaty wording. There are different treaty wordings adopted by different companies. So it will be different for proportional reinsurance and non-proportional reinsurance. I think I would have touched upon most of the concepts. It has been much longer than I expected. I thank you for bearing with me for 11 o'clock today
Your
night.
PPT, sir.
Thank you so
Thank
much,
you to
sir.
you.
Thank you very much, sir.
Extremely
Wish you
wonderful
all
session,
the very
sir.
best for
Sir,
your exams.
share your PPT, sir.
Sir, definitely I will share this PPT in the group. You can have this PPT for your reference. Definitely
Sir,
I'll
one
share
more
it.
question, sir.
Yes, ma'am. Yes, yes.
What is rate on line, sir?
Rate on line is nothing but it is used in catastrophe reinsurance, ma'am. Like I mentioned, this catastrophe reinsurance, there is no hard and fast rule of getting rating because we don't have enough historical data to provide rating accurately. That's why what will happen is the reinsurance company will say one particular percentage rate. For example, 5% is my rate for giving for this catastrophic cover, and he will say my catastrophic cover is going to be 100 crores. So 5% is the rate. Cover capacity will be 100 crores. Rate on line is nothing but applying this rate on my capacity. 5% applied on 100 crores will yield 5 crores. So this 5 crores is called rate on line. You might think why I should do this, because a reinsurance company will be giving catastrophic cover to multiple companies. So for each and every company, when he gives a catastrophe reinsurance coverage, what he'll do is he'll get the catastrophic cover percentage, he'll get the catastrophic cover capacity, then he'll apply this percentage on that capacity and he'll write down as a ledger. This ledger, what he'll do is he'll use it for reference for future requirements, so that this rate on line ledger will be helpful for him to decide on the catastrophe ratings for future policy requirements, for future catastrophe requirements. It has nothing to do with rating method or arrangements. It is purely there for a ready reference purpose of the insurance company or insurance company. Rate on line is nothing but you are applying the rate of premium on the cover you are providing. That is rate on line.
Okay, thank you.
Throw some light on derivatives, sir.
What, sir?
Throw some
Sir,
light
can
on
you
derivatives.
Sir, I'm not getting clearly, not getting your audio clearly. Sorry.
Sir, derivatives, sir. Throw some light on derivatives.
Derivatives. Okay, the options, derivative markets on that, right, sir? Capital market instruments you are referring to.
Yes, sir.
Yes, sir. Yes, sir.
Okay,
Yes,
this
sir.
capital market instruments, like derivatives are those securities. Derivatives will be the securities that will be having underlying value on some other thing. For example, you can consider as a very classical example is sovereign gold bond. Sovereign gold bond is basically a bond paper which derives its value based on the commodity. That commodity is gold. So it is kind of a derivative. A derivative is an instrument that derives its value from underlying commodity. You get the picture, sir?
Got it, sir. Got it. Thank you.
Sir,
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 Do
can
share
you
some
put
questions, sir, numericals for us, sir, if
Sure,
possible.
ma'am. Sure. I'll post this PPT and I'll also share some numericals. I'll try to share some numericals at the earliest possible time.
Sir, can you put some light on ratings of the insurance companies?
Ratings of insurance companies, like I said before, it is solely given by rating agencies, sir. There are well-established rating companies across the world. S&P is one, AM Best is one. So these are the companies that constantly analyze the financial statements of the insurance company and reinsurance companies world across. So based on the financial position of the reinsurance company or insurance company, they will provide ratings. If a insurance company is having very good accounting procedures, very good policy holder obligation satisfaction and all, they will be giving good ratings, and auditing procedures will also be looked after. If the auditing principles all are in good condition, the company will receive good ratings. If there is any lapse found in these procedures, the ratings will be reduced or there will be bad ratings. So it is purely used to identify whether I can have a relationship with this company or not.
Thank you.
Sir, I have two requests to you.
Yes, ma'am. Yes.
Hello, sir. I'm Pradnya I'm from DO1, Kalyani Nagar, Pune. Sir, please do write a book on reinsurance by yourself, because the book, means I don't want to offend or disrespect the the reinsurance book issued by III, but the way you have explained reinsurance, I think I won't forget it till my death. And means it is the best explanation. You have cleared each and every concept which I was confused about, and I was so scared. Actually, it is a very a small subject, or a very simple subject, everybody calls so, but there were many doubts which were unanswered, and you have answered every single of them. So please help all the students and write a book yourself, please. Everybody needs that on reinsurance.
Firstly, I'm very honored with your compliment. Very thank you that you have got such a clear understanding. I'm very happy that my wordings helped you.
So we are
I'll
honored
definitely
that
try to
you
have
are
some.
taking the lecture. We are actually, means I to be honest to you, I was going to skip the lecture, but I thought while traveling I'll at least attend it, so the time consumption will be utilized. And I am so very thankful to you, actually, the whole group who has arranged this lecture. And the second request was, do you have any other, if you can explain any other subject like this? I know it is too much to ask.
Okay. Okay, fine. But I
It is,
can, but considering the time constraints of the
I
exam,
know.
since the exam is merely placed 1 week
Yeah,
hence,
yeah.
that is one big issue. Otherwise, I will definitely try to help, because to prepare things, I need time. But this exam scenario is not very much accommodative, so that I
Yeah.
can't, I'm not refusing, but the time is like that.
This
Can,
is the best reinsurance lecture I have ever attended, sir.
Thank you.
In fact,
Thank
one
you.
of
What
the
is your
best
name, ma'am?
lectures.
What is your name, ma'am? What is your name?
My
Where are you
name
from?
is Pradnya Kavishwar. I'm an administrative officer in DO1 Kalyani Nagar, Pune, United India Insurance.
Okay. Thank you for your compliment. Thank you
Thank
very
you,
much.
Vishnu. Thank you. It was a great
Thank you.
lecture.
Thank you.
Thank you.
Thank you, sir.
Thank
So
Thank you,
Vishnu,
sir. Vishnu,
okay.
sir. Vishnu, sir, this is Rushikesh from BBKS.
Yes, sir. Yes.
Yes, sir. We are very thankful for this outstanding and enriching lecture. I am not due for the exam, but I have attended all the session. Thank you very much.
Okay. Thank you.
So
It
this
was
will
a
be
very great
available on
opportunity
YouTube,
provided by
right?
you.
Yes,
This
it will be available on YouTube. All the
Yes.
sessions are on YouTube, ma'am.
Yeah, thank you.
When will you upload this?
This is live, sir. You can now also visit the YouTube.
Okay, great.
Thank you.
It will be helpful if you could share the numericals also in this case.
Sure. I'll try to post some numericals. Again, I like the issue is the lack of time, but I'll definitely post some numericals. I'll definitely do that.
Thank you, sir.
Okay. Thank you. Have a good night. Thank you for sitting with me for this
Thank you
long.
very
Thank
much,
you.
sir. Good night, sir.
Thank you very much, sir.